All right, everything looking good on my end. Should be live here any second. Can go ahead and get this stream started. Welcome back to the channel, Crypto Trend Trader, with our Wednesday evening market update. It is 8 p.m. Eastern Standard Time on January 5th, 2022. Before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. So, got quite a bit to talk about today. A bunch of different things, and they are all related. So, definitely want to, obviously, some big volatility moves in the markets, in cryptocurrencies, in tech stocks, in the Treasury as well, which is the catalyst for said moves, in my opinion. So, now we're seeing obviously some sell-offs, across the board in the indexes as well. We were seeing some short-term strength in some of the other sectors, but now the rates are putting some serious downward pressure on some of these markets, some more than others. So I think that I did have planned for today the unveiling of a new / revised indicator, a new version of the Jewel Thief, which I have yet to officially name, but I might spend a little time and go ahead and show that off and just do a quick little explanation on that one. All the other indicators are listed down in the description below the video and all available for free, with the exception of the TJD Master, which is obviously for group members only. And then also this new iteration, new indicator, the Jewel Thief, or whatever I decide to call it, is going to be, at least for the meantime, for group members exclusively as well. As I do appreciate the support that they show me, and they basically make it so it's worth my time, and benefits the entire community that basically showing their support. So while eventually maybe these indicators will be publicly available, right now I have hundreds of, well, really thousands of people using all the publicly available indicators. Many of them are just the older versions of some of the newer indicators. So for now, this one again is going to be reserved for group members exclusively. So, but that being said, we will get to that a little bit later when we get to our crypto technical analysis. But let's go ahead and jump in over here and talk a little bit about the treasuries and the yield and what's going on in the markets, because that is essentially where all this pressure is coming from. So we have been discussing this situation right here, where we were basically putting in a symmetrical triangle or ascending triangle or flag, whatever you want to call it. So we basically have a flagpole up, and then we're putting in, a triangle pattern where we're basically oscillating inside of a range that is lower highs and lower lows. And the truth is, this is a bullish pattern and typically breaks out to the upside. And then on top of that, we're above the 200 exponential and simple. And now we were starting to show some weakness right here. But the most important thing to remember is we have a low, a higher low, and now technically a higher low as well. So the key areas we've been discussing and talking about was threatening this area right here or threatening this area right here. So a break above the 1.69 level or a break below 1.34 level would lead us then to threaten the next levels, which would be, a break above 1.75 or a break below 1.15. So those are the two key areas to look out for, as we would be putting in either a new cycle high or we would be taking out our previous low, indicative of the beginning of a downtrend inside of this uptrend, inside of the macro downtrend. So we basically have a long-term downtrend. We have a bullish bounce or retracement of the bearish move down. So we're just bullishly moving back to get back some of what we lost. And now what we were paying attention to is, were we going to break back down and go back down to retest the lows, or are we going to break up to the upside? So once we took out this right here, there's two main things, two very important things that are taking place. One, not only did we move up here and people are saying, oh, but rates, they were only at 1.5 or they're only at 1.7. These are historically low rates. It doesn't matter. Well, it's not so much the actual rate itself, but it's the velocity or the speed at which we approach that level. So when you see a big green candle like this show up all of a sudden, that spooks the markets. It spooks them bad. And typically you see continuation. Here we saw one like that, and we saw continuation to a new cycle high. Here we saw one like that, and we threatened the high again. Here we saw one like that, and we actually took out those highs. So now that we have taken out these highs right here, and we have showed strength on this, now the next area to pay attention to is right above our head. And the top, just by a wick, was 1.76, and we're back at 1.7 now. The bulls are in full control, and we haven't even flipped the slope line on the TJD TDMACD blue yet. So we have momentum in our favor, and there's still a lot of juice in the tank. There's still a lot of fuel in the engines if this thing wants to run. And we know for a fact that the Fed is tapering asset purchases and intends to have asset purchases at zero by the end of March. So we're going from $120 billion per month in asset purchases, which have been taking place for almost 2 years now, $120 billion per month for 2 years. And that's going to go to zero in March. And then they're talking about potentially, the Fed dot plot is 2 or 3 rate hikes this year. Some of them are calling for 4 now, and it's 25 basis points, 0.25%. Oh, big deal. Oh, that's nothing. Well, it sure is something if you look at valuations of all these speculative assets, including, tech stocks, cryptocurrencies, basically anyone that doesn't make money, anyone that's not a profitable company, the higher your multiple is, the more vulnerable you are. Things like cryptocurrencies that don't have multiples, they don't have profits. There's no way to actually value them. The only way to value these things is what somebody has recently paid for it. Or you're looking at fantasy, some rainbow chart or Plan B's, estimated Bitcoin targets into the future based on stock to flow ratios. Okay, sure. So let me get my kid to pull out his crayons and draw some colorful things that have no bearing on any actual information or anything, and then that will be our chart that we look at and we quantify the value of Bitcoin into the future. Okay, yeah, that makes sense. No, it doesn't work like that. I'm sorry, I'm not trying to hurt anyone's feelings, but it's the truth. The same way that if you have these companies, these tech stocks that are valued at, typically the way you value things in the past historically is by price to earnings. The price of the stock compared to its annualized earnings. Well, they don't even do that anymore for most of these companies because they don't even have earnings. They're not even profitable companies. They're losing money. They're bleeding millions and in some cases billions of dollars. They are bleeding billions of dollars per year, making no profits because they're on the Amazon, course where one day we'll be profitable if we just lose money long enough that all our competition goes away. So now they're not even valued based on price to earnings. They're valued based on price to sales. And in many cases, these companies have ridiculous ratios of price to sales. I mean, historically speaking, 20 price to earnings is high. And we have companies that are 200 price to sales. I mean, and they're not even profitable. That's not a bubble. That's not going to burst. These things aren't going to lose 90% of their value like Amazon did in the dot-com bubble. This time's different. Okay, sure. This time is definitely different. So anyway, that being said, so what we're seeing take place right now is we're seeing a threaten, not only our local high has been taken out, confirmed today, but now we are threatening the cycle high. So if we're threatening the cycle high, what does that mean? Well, it means that what we've been saying is literally happening. It's coming to fruition as discussed, as explained, as we've been talking about. So for all the people that are saying they can't raise rates because they won't be able to pay their debt. Okay, sure. You keep betting on that, and I'll bet on the technicals, and we'll see who's right in the end. You keep fantasizing about how they can't raise rates because it'll crash the whole system, and I'll explain to you why you don't understand what the hell you're talking about. Maybe they want to crash the system. So make sure that you understand what their motive is, what their goal is, what their intentions are before you say they can't do something or else. Because if you say they can't raise rates because they'll default on their debt and it will crash the system, sure, maybe that's true. But are you sure that they don't want to crash the system? Are you sure that they don't want to crash asset prices? Are you sure that they don't want to capitulate the economy? Oh, you didn't think of that. Oh, okay. So that's what we do. We think outside the box. So let's look at our 10-year Treasury yield chart on the weekly now and see what's going on exactly as discussed, exactly as planned. We tapped our head on the 200 exponential of the TJD master. We bounced down, put in a higher low from our previous low. We came up and hit our head on it again, came back down and put in a higher low from our previous low. We came in now and we have violated it. We have flipped it over blue. The slope line has flipped over blue. The previous 2 times it did as well, but now we're big and thick and past it, threatening the potential high right here. So what is about to happen? Well, we're going to come up here and touch the 200 simple. That's the next rational step. And more likely than not, we're going to basically bump our head on that and then come back down and consolidate again. The more times we bump our head on this, the more times we, hit our head on the drywall or on the ceiling, the more likely we are to break through it. And when that happens, that will be the culmination of the move that we've seen take place right here, which if we pull on our drawing tools here for a minute, don't mind how busy this chart is, we see obviously we have a massive cup and handle pattern that has been forming based on our multiple drives of divergence. That was our bottoming pattern right here. We have our cup, we have our descending channel that forms the bottom of the handle, then we have our handle move to the upside, we have our consolidation, and now we have the break. So the only rational thing to happen after that is for us to break out to the upside and get the measured move. And the measured move is what takes us up to these key levels we've been discussing. Anywhere from, roughly 2 point, obviously we'll stair step our way up, but somewhere around like that 2.7 level is, rational. So we're paying attention to that. Obviously we were seeing some weakness. We were seeing some, potential for consolidation here, but it only makes sense that we're going to come up here and threaten that 1.78 level. When we take out our local high right here or our cycle high right here, after that, we'll have broken through the 200 simple. We'll have flipped the slope back over on these. We obviously went into a bear market when we flipped the slope negative on these, and they turned red and pink respectively right here in May of 2019. So if we consolidate here long enough, if we close above 1.76, we will see both of these flip over blue on the TJD master, and that will be the beginning of a bull market in, 10-year Treasury yields, which makes perfect sense. Obviously, we hit 0, or as close to it as possible. So the only rational thing after that is for us to revert to the mean. So here we see again on the monthly, as we've been discussing, as we've been expecting, as we've been planning, we see we have built up a massive amount of momentum to the upside. We have bounced the blue stochastic on the jewel thief, basically off of the pink stochastic. We see the hard buy signal coming out of the bearish control zone. We see a bunch of green histograms. We have crossed above the red slope line. We're above the 0 line. And all we have to do is just stay above here long enough. And this is about to flip over blue, saying that we have momentum on our side. We have velocity on our side. We have the 8 and 21 flipped back over green. So the next rational move is we start to put in the measure move of this cycle and we revert to the mean, which is a retest of the 200 exponential and simple on the monthly, which is 2.67. No, it'll never happen. It'll crash the economy. Everything will go to 0. We'll go into a recession. We'll go into a depression. Sure, maybe we will. Maybe we will. And maybe that's the plan. Or maybe they lost control. Or maybe it won't. Any of those is a possibility, but I think we should always consider the possibilities, not just what we think or what we heard someone else say and then just regurgitate it as if it's a fact. So we have an inverted head and shoulders on the monthly here, and we're violating the neckline for the first time. We're taking out our cycle high, and now we're paying attention to the potential of our measure move, which just so happens to take us up to the reversion of the mean, which is back at the 2.72 level, which is also the target for us to top out here at the 886 of our Fibonacci retracement from top to bottom. And it just so happens to be also the top of this long-term trend that we've been inside of since the 1980s. And what happened right here in the 1980s? This was when we had massive amounts of inflation taking place, and Paul Volcker, the Federal Reserve chairman at the time, raised rates to 20% to combat the hyperinflation. Does any of that sound familiar? People are worried about hyperinflation. Rates are at low. We're going to combat the inflation by raising rates. Does any of this sound familiar at all? Is history possibly repeating itself? Now, again, I don't think we're going to go to 20%. I don't think we're going to go anywhere near 20%. But to sit here and argue that a 2.5% rate is going to bankrupt the federal or bankrupt the United States government is the stupidest thing I've ever heard in my life. It doesn't make any sense. We were at 2.5% in 2008. So why all of a sudden now? Well, we printed all this extra money and there's trillions of dollars in extra debt. Well, what was the national debt in 2008? It was what, 8 trillion, 10 trillion, 20 trillion? And now it's, 30 trillion? So now we all of a sudden can't pay our debt? I mean, it's not good for the economy. It's not good for the GDP. But we don't just automatically default now because we have to pay more in interest. Not to mention, we can think outside the box and use our actual brains instead of just regurgitating all these idiotic talking heads and think about things like, well, what would you do if you were the government and you wanted to lock in a low rate because you were about to raise rates? Well, what would I do? Let's see. Let's use our brains here and think outside the box. If it was up to me and I was getting ready to hike rates up through the roof, instead of rolling over a bunch of short-term debt, like 2-year and 5-year debt, what would I do? Well, I would issue a federally backed treasury with a 50-year or 100-year time horizon. So is it possible that the government would say, okay, we're going to issue a 50-year treasury bond at 2%? Or 2.5%, or 5%, or 3%, or whatever? It's definitely possible. And then what do you do after that? Well, you lock in those rates at 3% or 4% or 5% or whatever they decide for 50 or 100 years, and then you hike the Fed funds rate through the fucking roof. And you smash inflation, you crush the economy, you fund the debt long term into the future. I mean, that's one solution. And look, we just thought of it together here. Oh shit. No one else in the whole world thought of that? Or no one's talking about it because no one else said it first and they're just regurgitating what they heard from everyone else. And I'm not talking down to you guys by any means. It just blows my fucking mind that all these people sit here and talk like in absolutes, like they know what's going on, like they know what's going to happen, like there's no chance that these things can take place. And I can think of 10 different reasons and 10 different ways that they could easily solve these unsolvable problems, like raising, the Fed funds rate above. We're at 0 right now. we're literally at 0. So people are like, oh, they'll never hike rates 4 times in 1 year. They're not going to be able to hike rates to 1.25%. That's just a game changer. It's going to break the whole system. Okay, sure. Yeah, I'm sure it will. I'm sure 1.25% is going to just completely destroy everything, and the U.S. is going to default on its treasuries, and the whole country's just going to go out of business. I'm sure. Makes total sense. I mean, it blows my fucking mind how stupid all these people are to sit here and say all this stuff, and that's why you really got to be careful who you're listening to, because there's a couple educated people on the macro that understand what's actually going on. And then there's like 100 or 1,000 other people that just regurgitate the same shit over and over again and have no actual grasp of what's taking place. Sodos. Hey, exciting times. What's going on, brother? Shipwreck says, and it's an election year. This isn't lasting. The press and his people will tell the Fed to ease up, and they will. So your argument is the Democratic president will tell the Federal Reserve, which is independent from the government, and also the Fed chair of the Federal Reserve has specifically said that he won't engage in politics and is also a Republican. So the Democrat that has no power over the Republican federal chairman he's going to tell him to ease up so that he can get reelected, when the reason that he's worried about getting reelected is the hyperinflation and the way that they're going to try to stop the hyperinflation is by raising rates? Think about what you're saying, dude. It doesn't even make sense, Shipwreck. The Democrats are polling horribly right now and afraid that they're not going to get reelected because the people are afraid of the inflation and it's crushing them. So the solution to the inflation is raising the Fed funds rates, because if money is extremely cheap and it's causing rampant speculation, and that's causing everybody to, all the prices to go up on everything, because everyone is buying anything they possibly can to try to beat the inflation rate, how is the Democrats coming out and telling the Federal Reserve, which they have no control over, how is them coming out and saying, hey, don't raise the Fed funds rate and stop all this rampant speculation to stop the inflation, going to help them? It literally doesn't even make sense. So your argument is that, and let's just say you're right. Let's say Joe Biden and the Dems, who don't even have a grasp of what's taking place, let's say they come out and they say, Jerome Powell, hey, don't raise the Fed funds rate because that's going to cause problems with the stock market and the speculative assets, and we don't want you to do that because then we won't get reelected. And then let's say Jerome Powell says, sure, I'm going to listen to you because you're in charge of me and that's what I'm going to do. So, okay, I won't. And then what happens? The inflationary spiral continues to go out of control. Price rises go up. Speculative assets go through the roof, continue to rise at exponential rates. People continue to speculate like crazy, spending and buying anything they can. People stop going to work and start quitting their jobs at even faster rates, causing more inflation to take place because no one's creating goods or services. Therefore, the price of those goods and services is going up because there's less of them being provided. And then there's more speculation taking place. And then the asset prices that are causing all the inflation continue to go up. Therefore, the people with those assets continue to speculate and have more money to buy up more stuff. That's literally an inflationary death spiral. So your argument is that they're not going to do it? It's happened before through the years. Point at a specific time, Shipwreck, and then we're going to keep moving here. Point at a specific time in history. Let me know a date or time period when there was inflation and they didn't raise the Fed funds rate to combat the inflation. I mean, I'll wait. Because literally, I don't know if you've been paying attention to the Federal Reserve and what's been taking place, but, you know, straight from the horse's mouth, they have literally been saying for how many decades that their Fed funds target for the inflation rate is 2%. And they haven't even been able to achieve 2%. And now you have the CPI at like 6.2%, printing higher and higher prints. So they haven't been able to achieve 2% for literally decades, when that was their goal based on their numbers and how they calculate it. You know, I'm not saying it's the correct numbers. I'm not saying they're not manipulated, whatever. But they haven't been able to achieve 2%. And now it's at 6.2% and about to get an even higher print next time. And you're telling me that they're not going to be able to raise rates because it's an election year? That doesn't even make sense, dude. 1972, 1986? Dude, what happened in 1972 and 1986? I mean, are you joking right now? I can't even tell. Are you joking? Is this a joke? The rates were literally going through the roof right here, okay? That's 1970. 1972 is like right down here, and then inflation starts going out of control. And what happens? What does Paul Volcker do to stop the hyperinflation? He raises the federal funds rate to 20%, dude. That's literally the end of the inflation in 1981-82. That's when the Fed funds rate, I mean, look on this right here. Do you see the 10-year Treasury yield right here is at 15.75%? The Fed funds rate was at 20%, and that's what stopped the hyperinflation. And it was in a spiral from arguably an uptrend, but a spiral from 1977 to 1980. The end of 1981 or beginning of 1982, it literally went from 7.5% to 15%. But that's my point. I know you're not trying to argue, but that's my exact point. The last time we had inflation and inflation was an issue was this period. And what did they do to combat the inflation? They raised the federal funds rate. And that was, to 20% to stop the inflation. What they're doing now is stopping people making money by what they just did. Man, I'm really not sure what you're referring to. Stopping people making money by what they just did. I really don't know. I'm really not sure what you're talking about, dude. But please think outside the box, man. People are saying they can't raise the Fed funds rate. We're at literally record lows. Look at this chart. We're at record lows. We went down basically to zero. The president will talk to them and let people make money again. What does let people make money mean? What are you talking about, let people make money? Are you talking about let asset prices continue to inflate and speculate on them? Dude, you're so wrong. I'm sorry, man, but you're so wrong. There is a gigantic disconnect right now between actual asset prices in the stock market and like your normal, like average Joe and Jane, like in the economy. Okay. So while we are here and we're interested and we're invested in speculative assets and we're making money hand over fist through like this inflation and, money printing, whatever you want to call it, whatever, reasoning is, whether you want to say it's monetary policy, it's fiscal policy, a combination of the two, whatever. The fact of the matter is, I'm going to tell you right now, the fact of the matter is an absolute fact. If the Democrats or the Fed do not do something about the Fed funds rate or something else to combat the inflation that is taking place right now, the people are going to vote them all out of office, which may happen anyway, but it's definitely going to happen if they don't get the inflation under control. And we know for a fact that the only way to get the inflation under control is by raising the Fed funds rate. So it stands to reason, based on history and economics, that the most likely situation is that the Fed will increase those rates. And will it affect asset prices? Will it hurt speculation? Will it cool off the stock market? Will it cool off cryptocurrency? Will it cool off the housing market? Yes, it 100% will. And what percentage of the population will that hurt? Probably like what, 10%, 25%? Because those are the people that are invested in stock markets, in cryptocurrencies, in houses. So sure, 10% of the people or 25% of the people will feel a little bit of pain after a parabolic bull run in all these markets that has lasted 10, 20, even 40 years. But it will cool off the inflation that's taking place right now. And that's what's most important, because if none of these politicians can get reelected because inflation's through the roof, then they lose everything, because that's literally all they care about. They don't care about the economy. They don't care about asset prices. They care about power. That is the number one thing to them. Sure, the economy, sure, their donors, sure, their other things are important to them. But I'm telling you right now, you don't think that the power is the most important thing to them. You're delusional. Yes, they will be out of office. That's why I was saying they will talk to the Fed. So rates will adjust again for money to flow so they get votes. But see, you're talking backwards right now, dude. You're saying, yes, they will be out of office. So if inflation continues to go nuts like it is right now, they will be out of office for sure, because everybody will be pissed because there's inflation. But if the Fed raises rates, you're saying they'll be out of office also. But the raising of the rates is what combats the inflation. So you're literally, it doesn't make sense what you're saying, dude. The rates will adjust again for money to flow so they get votes. But that doesn't make any sense. The rates are the problem. The rates are too low, causing rampant speculation, causing all of the inflation and the bottlenecks in the supply chain and the lack of people creating goods and services because they're speculating on assets instead. So literally, you're confusing one thing for the other. You have to look at what the cause is. You have to look at what the effect is. So if the only way to get the effect, which is the inflation, under control is by rising rates, will cause the inflation to calm back down and cool back off, and the economy to cool off, and the housing market to cool off, and asset prices to cool off, and cryptos to cool off, you're saying that they can't raise the rates because it'll cause those things to cool off, which will cause inflation to get back under control because they won't get voted back into office. You're talking in circles, man. It doesn't make sense. I mean, but anyway, we've spent enough time on this. Really think through what you're saying, okay? Because the fact of the matter is the only way to get the inflation under control, the only way to get it under control is, one, to stop the spending, which they're not going to do. Stop the deficits, which they're not going to do. Two, create more goods or services. Therefore, you have the same amount of money chasing after more goods and services, causing the prices come down, or to raise the cost of money, which is basically the Fed funds rate or the interest rates. So if money is extremely cheap and that's what's causing all the inflation because there's not enough goods or services and all the asset prices are going up, so then people are buying up all the stuff, the only way is to either create less demand or create more supply. So you can't create more supply because nobody wants to go to work anymore. And we have literally like massive amounts of open jobs and there's nobody to fill those jobs to create more goods or services. So therefore, we know we can't create more goods or services because we've been trying. There's like 4.5 million people quit their job last month. So that's like 1.5% of the entire population of the United States, and only like 50% of the population of the United States goes to work. So that's like 3% of all the people working just decided they're not going to work anymore. So, I mean, you know, granted, that's a one small little number, but my point is we've been trying to get more goods and services, and it's not working because of supply chain bottlenecks, lack of people wanting to go to work and provide those goods or services, lack of manufacturing taking place in the United States. Therefore, we're importing things and there's record trade deficits. So what you're saying literally doesn't make any sense. So if one side of the scale we can't affect, no matter what we do, we have to affect the other side of the scale. So the other side of the scale is the cost of money. So the cost of money is literally the interest rate. So the lower the rate is, the more people are going to borrow money because it's cheap and it's easy to get a return on. So if the rate of money or the cost of money goes up through the interest rates, if you have to pay more in interest to borrow that same money, you have to then make more on the back end or it's not worth it. So eventually you start tipping the scale back in favor. So if the rate goes up to 2%, or 3% or 5%, a lot less speculation will take place because it will be more difficult to net win with a higher cost of that money. But if it costs zero to get money now, you can literally put it anywhere and all you have to do is do better than zero. But if it costs 2 or 3 or 5, or in Paul Volcker's case, 20% to borrow money, sure, it's going to crash the economy. Sure, it's going to cause a recession or, you know, potentially depression or stagflation or, you know, some other horrible effect. It's going to be very painful at the time, but it will stop the inflation. And that is what's taking place right now is they can't stop the inflation. They've lost control of it. So the only way that they can affect it is by making the cost of that money more expensive, therefore causing the inflation or the speculation that's causing the inflation to calm back down. So that's my point. But I mean, it is what it is. I mean, trust me on this one. Okay. Well, we can see what happens. We'll see what happens in the future. But I mean, I've literally been right about everything for months and months and months while everybody else was talking about literally the opposite. And literally everything I've said has come true to a T. So maybe this time I'll be wrong. Maybe they will continue to have the Fed funds rate at zero. Maybe they will just continue having free money. Maybe inflation will just continue to roar. Maybe we'll still have a massive deficit on goods and services and, you know, massive job openings. And, you know, maybe the Democrats will, I mean, they are pretty stupid. So maybe they will just say, hey, you can't raise the Fed funds rate because it'll hurt asset prices, but the inflation will go out of control. But either way, we're not going to get reelected. So who cares? It's possible. It's definitely possible. But I mean, let's be real here. You know, the more likely situation here is reversion to the mean and the rates go up. And I'm not talking about 20%. Okay. I'm talking about 2.5% or 2.7%. We're talking about 2008 levels. Okay. That is not going to be a game changing, world ending percentage on a 10-year treasury. That means our Fed funds rate would be at like 2% or something like that. It's not end game, like end of world stuff by any means. So, But anyway, let's keep moving on here because we got a lot to talk about. And again, we can revisit this in, a couple months or a year or whatever, and we'll see. Maybe I'll be wrong. And, I will gladly admit it. I've been wrong about things before, and I gladly admit when I'm wrong and adjust my view accordingly because no one can see the future. But I'm telling you, there's a pretty high likelihood that I'm going to be right on this one again. So now let's take a look at, we'll look at the VIX. Obviously, we know the VIX is spiking up here. Again, we're still in the neutral zone. We're still here. We're basically still in the neutral zone, especially as long as we're in the dotted lines of the descending channel and between the dotted line of the descending channel and the dotted lines of the horizontal channel, we're basically in the neutral zone. So while we're seeing the VIX spike here and we're seeing some pressure on the markets, we're still in the neutral zone as far as I'm concerned. So until we either break back through the top of the range or break down through our horizontal support here, which will obviously be taking place before we break through the bottom of the range, this is still basically neutral. So we're seeing a little pressure from some of these things now as the rates start to spike, but I don't think it's end game by any means. Oh, and I do want to talk about also, we are seeing now, obviously TLT is rolling over and we're losing the 200 exponential and simple. So the bond market is, obviously taking a hit right now. But if you notice now, we are actually seeing, we have been talking about the flattening of the curve. We are seeing now, and it has actually been taking place for a little while, but the 30-year long duration bond interest rate is actually inverted compared to the 20-year. So we're seeing now exactly what we've been discussing, yield curve inversion, which essentially is the prequel to a recession or potential depression. So something obviously has to change, or we're going to go back into recession/depression anyway. So U.S. oil obviously spiking. OPEC has come out and said that they will be releasing more oil. So maybe that's going to cause, oil prices to roll over. We're seeing in the technicals on the daily, obviously still inside the bullish control zone, but showing a little bit of weakness. Definitely still room to run here, but we're basically in our target area for a potential short-term top. But the most important thing to pay attention to is we still have our 3 drives of daily, 2 drives of daily, but 3 drives of weekly bearish divergence. So what we would expect to happen here, if this triple bearish divergence is going to play out on the weekly, which I'm on the daily chart, but it's on the weekly as well. What we would expect to happen here is to now put in a lower high and then have an aggressive move back to the downside. So if we do have that take place, I would expect us to break the 200 simple and exponential moving average on the daily, break down to the bottom of the range, which is our green support right here, and then potentially retest our green box area, which has been our target this whole time, and obviously the red resistance, which we would expect to flip as support. So I do fully expect oil to come down here around mid to high 50s or, low 60s, but put in a new low right here. So we'll have to see what happens. But I do expect this triple bearish divergence on the weekly to play out. So next, if we look at the Dow Jones, we obviously saw a pretty aggressive sell-off right here, back down to support. Again, we have bearish divergence on the weekly. We're at very high levels, looking very, very toppy. We'll have to wait and see what happens. S&P, very aggressive candle right here. This is all specifically as a result of the move that we're seeing on the Treasury yields. So not necessarily as much the level of the Treasury yields, but the speed at which it's going up. And if we violate that swing high, which it looks very likely to do, I mean, we're literally barely below it right now. If we violate that swing high, that is going to cause a revaluation of all these prices, especially these stocks and these speculative assets, including most of the tech sector and also crypto that don't have actual earnings. If you're not a profitable company right now, you're going to be in big trouble because there's only 2 ways things can change. You can either make more money or your, basically ratio can come back down. So this is what we've been talking about and expecting as these rates rise. We would expect valuations to come down because basically all they are is, the future value of that company based on sales with hopes that one day they will be profitable. So if the cost of money to speculate on them becomes more expensive or the rates go up, the amount you have to pay to borrow that money, we would expect the valuations to come down accordingly. The same way that if you can get a mortgage on a house at 2% versus if you get a mortgage on a house at 4%, you would expect the value or the price of the house to change inverse to the rate that you're paying. So if you get a mortgage at 2%, you're willing to pay more for the house up front than if you get a mortgage at 4%. It would mean you're willing to pay less for the house because over the duration of, let's say, that 30-year period that you're borrowing the money for, you're going to pay more for the house because you're paying twice as much of an interest rate. And when you compound that annually over 30 years, it makes a big difference on the value of the house. So it's very important. And then also, if we see the mortgage rates continue to go up as well, what is that going to do to the housing market? It's going to cause a ton of pressure on the housing market because what's going to happen is people will not sell their houses because they know they can't refinance and get a better mortgage than they have. So if you have a 30-year fix right now at 2% or 1.75%, you're not going to sell your house and get a better mortgage. You're going to get, a 3%, 3.5%, 4%, maybe 5%. We'll see what happens. So you're going to see less of these people potentially wanting to upgrade and continuing to buy houses, etc. So therefore, the demand of these houses is going to go down. We'll still have less supply going on the market because these people won't be willing to sell their houses, but it then causes like stagnation in the housing market. So there's a lot of things that are affected directly by this. So we see the S&P is topping out again at that green resistance of the upper band of our channel. So paying close attention to that. We bumped our head on it 1 time, 2 times, 3 times, 4 times, and we got a pretty damn bearish looking handle here based on that tiny little move in the rates. So again, it's not the percentage, it's not the actual rates themselves, but it's the violence at which they moved, the velocity at which they moved. So the NASDAQ obviously looks, just as bad or worse, breaking back down. So we want to hold this green ascending support line. If we lose that ascending support line, it's going to really look like basically, this is our head carving out right here. We're going to come down, retest the 200 exponential on simple at 14,626, at which point in time we really got to pay attention to this red support line, which would essentially form the neckline. So we would expect basically the left shoulder, neckline, head. If this keeps rolling over right here, we lose this support. We come down to the 200 exponential and simple, potentially back down to the neckline here, get a reaction rally back up, put in a lower high, and then that's really going to look like a head and shoulders. Does that have to happen? No, it does not at all. We could easily find support here, continue to the upside, and everything's gravy. But it's worth paying attention to, as this is what topping patterns look like. So again, I'm not saying that these have to be topping, but we're definitely seeing some indication. So Russell next. We obviously had our failed breakout or throw over here, came back up, tried to save the 200 exponential and simple moving average on the daily. So we had basically the 200 simple had rolled over a couple times and we've been trying to save it. 200 exponential has hinted at a red slope line here. And we know that once price action is below the 200 exponential and simple and they are both flipped over, pink or purple and red at the same time, we are entering into a bear market. So the same way we were in a bear market right here before the COVID dump in February of 2020 and proceeded to, after we entered into a bear market, have a sell-off of 38%. So we had a 38% downside right here once we flipped these over red. And now once we flip them back blue, we had obviously the exponential flip first. We had the reversion to the mean, the retest, the attempt to make sure that they were going to act as support. They did. We had one more reversion. We got front run. It got bought up aggressively. And then here we see the 200 simple flips over blue. From that point in time, actually I should go from price, not the actual moving average. From that point in time, what happened? The Russell went up 59%. And now that was a bull market. And now this is, and again, you can determine a bull market however you want. You can determine a bear market however you want. Some people in the stock market say once something goes down 20%, it's a bear market. Well, whatever. How's that going to work on crypto? I don't think that's useful. A 20% move down makes, to me, not useful because it doesn't take into account volatility. So for me, it's the slope of the 200 exponential and simple. And that's why the 200, that's why the TJD Master works so good because it's not subjective. It's factual. It uses actual data that's used by market makers and, whales to determine trend. So right now, the Russell is confirming, for basically we have attempted to confirm it once, attempted to confirm it twice, attempted to confirm it a third time. Is it possible we save it again and just keep chopping sideways? It is 100% possible. But the more times we confirm a bear market or threaten a bear market, the more likely we are to get said bear market. And if we lose our support down here at the bottom, which it looks like we're going to try to find support right here and then potentially move back up, if that fails, or if we see continuation to the bottom of the range, we have to hold $2,131. If we fail to hold that level, we would expect to get the measure move to the downside, which that's our measure move. It's just the distance from the bottom of the channel to the top of the channel. And that will give us our potential target down here of like that 1900 range. So again, it does not have to happen, but the more times we threaten this, the more likely we are to enter into a bear market. And I'm not the only person looking at this. This is literally what Wall Street, what trend traders, what market makers, what whales, what smart money determines trend by. So let's look at the indexes real quick, and then we'll jump straight into look at the DXY, and then we'll look at crypto. So and actually we're going to pay attention, take a look at the new indicator as well. So XLE obviously broke out, seeing some strength right here, holding outside the range and still looking stronger than most. Energy sector. XLI industrial, once again attempting to break out to the upside, but failing to hold that level. So again, we have the same resistance. We would potentially have it act as support. Last time this happened, we got a little double top right here, and then we broke straight back down all the way to the bottom of the range. So maybe it holds this time. We see continuation. Maybe it breaks down from here. We'll have to wait and see. But if this area doesn't hold, again, it looks bearish, and we probably revisit the bottom of the range. That is industrial. XLB material. So material broke out to the upside right here, and now we have a shooting star rejection. So we put in a new high, which is good, but now we have a very bearish looking candle. Is it possible we hold this level and continue to the upside and play out the remainder of the measure move? It definitely still is. We still have our target in place, but when you start to see indications like a shooting star rejection candle like this, the likelihood that this could potentially be a top really looks probable at this point in time. Now, a candle is much less reliable than a, pattern amongst candles. So a single candle can tell you, hey, this could be a rejection and potentially we could get downside continuation. A candlestick pattern or multiple candles can give you confirmation based on multiple candles, giving you more of an indication that we're seeing a top or a bottom. And then an actual chart pattern, like a triangle or something like that, gives you even more of a grasp because it's giving you a price action range to look at, whether it's a channel, whether it's a triangle, a head and shoulders pattern. That's even further confirmation. And then the indicators and oscillators can help us to determine, momentum, relative strength, etc. So when we couple all these things together and we use one to tell us what's likely to happen with the other, which tells us what's likely to happen to the other, we can gain multiple forms of confluence or confirmation. So that's why each of these is an integral part of our technical analysis. So that is materials. So next we see the financial sector. So again, we topped out just above the 1.5 fib extension. We're still expecting to tag that 1.618. So we did technically put in a slightly higher high, but again, we didn't quite make it to 1.618. So I'm not ruling out the potential for this, but we did leave a small gap behind right here. We did get a pretty aggressive rejection, but I still think it's likely that we do come up here to that 4108. After we tag that target, everything changes. We'll reset, we'll reevaluate, but I do think we still come up and tag that target. Is it possible we come back down and fill this out first? Sure. But we very clearly have a W, a double bottom right here, and we're just putting in the measure move. We're also hitting our Fibonacci extension target, or almost. So that's financial sector. XLY, so consumer discretionary. So again, as the economy slows, as we see potential, revaluations occurring, as we see, potential pressure on the market as rates rise, what gets compromised? Discretionary purchases. Okay, this isn't stuff that people need. It's stuff that people like. It's stuff that people want to buy. In many cases, it's premium goods. So we would expect to see continued stress or, pain on this if in fact rates are going to rise. So we have a very clear double top right here. The area we were paying attention to was that top at 212. We did not want to see this come up here and put in a lower high. And we were talking about the measured move breakout to the upside, basically taking us back to retest that high, but did not want to see it top out. And now it looks like that's exactly what we're doing. So when we come back down here now, we want to see what was previously resistance hold as support, and then we could potentially get that continuation. So definitely looking like a little bit of a danger zone. We're also seeing what looks like a rejection on the red slope line of the TJD TDMACD, and we're also seeing the stochastics are rolling over and potentially threatening the bullish control zone. So again, looks very toppy as expected. So now let's transition here. So now we see consumer staples. These are necessities. These are things that people need to buy. So regardless of what the situation looks like, we would expect these to stay stronger than some of the more speculative purchases people would make, like, consumer discretionary. So the chart looks stronger. We're breaking out. We're at new all-time highs. So while we do have a weak candle right here, and we may see some pressure, I think this chart will hold up better if we start to see continuation and continued pressure. Next is XLV, so healthcare. So healthcare all but hit the measured move breakout that we were expecting. Basically tagged our box. Didn't quite get up to the target, so it underperformed slightly. But now here we are retesting the breakout level. Potentially have another level from that previous high right here. But we are getting the hard sell signal. We have left the bullish control zone, and we're seeing a bunch of red histograms. So this is stronger than most. It's at support right now. But it does look like we could easily see some continuation to the downside. And this could look like a failed breakout or, basically a throw over. So we'll have to wait and see. But does not look nearly as strong. I would expect this sector to hold up better, though, if we do start seeing some pressure from the rates. XLU utilities, again, I would expect this to hold out stronger. We can tell by the chart we're at all-time highs. We're still above our previous resistance, which we would expect to act as support. We really want to see this level hold and then see continuation. So here we're getting a buy signal at the top of the range, putting in some slight bearish divergence, but a little less alarming because this thing has been consolidating slowly and bullishly for so long. So I think this one is more likely to hold up, but probably going to see pressure as well. So XLK Tech did exactly what we said. We basically have this clear red resistance line. We were at the top of the resistance. Where do we expect it to top out? Same place it topped out the last 3 times. We also see very clear triple bearish divergence taking place, which we pointed out on our last stream. We have a high, we have a lower high, we have a third lower high. We have lost the blue slope line. It has flipped over red now. And here we have a high. We have I think we invalidated it. Yeah, we invalidated on the stochastics, but we have it on the TJD TDMACD. So we have triple bearish divergence as we're putting in higher highs on price action, but we're putting in lower highs on the TDMACD. We're now seeing, basically, we have left the bullish control zone. The Stochs are angled to the downside. We're below the 8 and 21. Looks like they're going to have a bearish cross. And it looks like, obviously we have lost the slope and we're seeing red histograms and a rejection coupled with that daily bearish divergence. So it looks like we're going to threaten this support level once again at 164.50. But more than likely, if we come down here and threaten this and we see the bearish divergence playing out, we would get the breakdown and the measured move to our target down here to the downside, which is a retest of a 200 exponential and simple. So we could easily chop around here. We could easily have a little bounce, but it does look more likely than not that tech is going to come back down here. Now, obviously, if we see some of the pressure on rates ease up, maybe that doesn't happen. But I'm telling you, if we see a new cycle high on rates, we probably break down here and we do it fast. XLC communication. It looks terrible. We've been talking about how this is literally the worst chart of these sectors, and we topped out. We've had very clear descending resistance. We broke down below the 200 exponential and simple. We retested and hit our red box area perfectly, which lines up with the 200 simple. It lines up with what was our support that's now acting as resistance, and now we're rolling over. We see the 200 exponential has flipped over red, and the 200 simple is almost flat. So all we have to do is just not trade back above $80, and this will go into a confirmed bear market. So literally, unless the bulls show up and push us above $80, this just goes into a bear market. So hard sell signal, we left the bullish control zone. We're seeing red histograms. We're breaking down below the 0 point. The 8 and 21 are getting rejected. We're losing all our moving averages, and we cannot break above our descending support line, resistance line rather. So again, it looks like it's going much, much lower. We can have some various support levels along the way. I think the best thing to do is just fib from the bottom of the range to the top of the range and just pay attention to our macro levels. So going back to the CVD dump mid-March to our high right here from September, we see our 236 is down here at 71.5. So if we touch that 71.5 level, that is basically going to confirm that we have put in a macro high based on our Fibonacci retracement. Once we tag that 236, we would expect obviously, some sort of bounce, maybe a reversion to the mean, retest the 200 exponential or simple, one last attempt to save the trend before we see bear market continuation. XLRE, so real estate obviously took a massive hit right here. So why is this affecting real estate so much? Well, if we see the rates go up, just like we talked about, that hurts the value of the homes. The higher the rate is on the amount of money that you're borrowing, the less you're going to pay for a home because the more it ends up costing you. Because if you take a house at $100,000 with a 30-year fixed loan at 2%, and then you take that same house and you say you're going to get a 30-year loan at 4%, you're going to be paying a lot more for that house, even if the sticker price is still $100,000. And obviously $100,000 is not a realistic number. But my point being is that by the time you compound out that extra 2% interest, it makes a massive difference on how much you end up paying for that house over that 30-year period. Therefore, if you're calculating the value of that house as the rates rise on the loan that you would get for that house, you're going to pay less for the house up front because you're looking at the end game price of what it costs you. You're not looking at the sticker price up front. You're looking at what the payments are going to be or what the value of the home is going to be. And that's why we're seeing this immense amount of pressure suddenly on the real estate market. So we did tag our first target. We didn't make it up to the 1.382, but obviously we have the hard sell. We left the bullish control zone, bunch of red histograms. Looks like we're going to lose the 821, and more likely than not, we're coming down to like 45.71. But we do have some stair steps. We do have quite a bit of support along the way down. So. XTN, transportation, again, trying to break up and put in our double bottom right here. But we know for a fact, based on historical data, that typically the transportation sector, every time we have looked at this chart, and I'm going to do it real quick because we've done it over and over again, we see a massive ascending channel. We see a massive ascending channel. We see a massive ascending channel. Every time we break down from that channel, we attempt to push back up and fail, and then we capitulate. Break down from the channel, attempt to push back up, we fail and capitulate. Attempt to push back up, we potentially fail right here and capitulate. So we need to pay close attention to what's happening right now. And also, we know cyclically, this was a top in December. This was, well, depending on where you want to go from, this was a top in December. This was a top in December. This was a top in December. So again, here we have potentially our cyclical top of the transportation sector, which obviously trades very technically based on like the actual like time cycle analysis, and obviously that has to do with like holidays and retail and, basically the cost of transporting goods and the demand of those transported goods. So hail, obviously, we've talked about this quite a bit. It basically came back down, retested support, bounced up, officially in a bear market. We see it's below the 200 exponential and simple. They both have a negative slope. This thing looks like it's ready to capitulate. I would expect it to lose this 52.90 level in green and finally come down to the 236 at 49.72. That is our macro level from the CVD dump to our high right here. Once we hit that 236, we confirm that we have in fact topped out this Fibonacci, and then we would expect stair stepping on the way down as this has confirmed a bear market, and we would expect continuation to the downside. Our next target is the 382 at 40.23 after we violate that basically like 50 level. And again, it's going to happen over time. Probably not going to be one big candle. Of course, every time I say that, we get one big candle. So Jets is next, confirmed a bear market. Once again, transportation sector. This one is loaded up with airplanes. So, obviously a weak sector, a terrible sector, and, looks even more terrible. We broke down from ascending support line. We broke down already to the macro 382 from the CVD low to the high right here. We have confirmed a bear market. We attempted to retest, and basically a reversion to the mean move right here. And it looks like it's rolling over. So we do have momentum in our favor. We do have technically the bullish control zone in our favor, but overall looks pretty weak. And, fundamentally, obviously, aeroplanes not looking so great. UPS, obviously we're hearing about tens of thousands of flight cancellations. We're hearing about, people that are doing anything and everything to not fly. We're potentially looking at transportation costs changing as we have less flights going, less goods needing to be transported as transportation sector closes, or, retail, sales go down, or international travel goes down, or business travel goes down. A lot of headwinds for airplanes and transportation of people and goods, which is basically all that sector is. UPS, again, transportation sector topping out at the same resistance level as it has done these previous 3 times. Is it likely that we break through this? It's possible, but in my opinion, it's more than likely just going to come back down and retest the bottom of the range. So we have the 200 exponential and simple below us. We have 190, but again, very cyclical. We're seeing essentially bearish divergence taking place on the daily. We're seeing bearish divergence taking place here on the daily. We're leaving the bullish control zone, and Stochs are coming to the downside. So once again, looks very, very toppy to me. And then FedEx, obviously, finally got the majority of the move back up here, finally retested the 200 simple. But again, I would expect rejection here. Technically has not confirmed a bear market as it reclaimed the 200 exponential. But to me, this is just a reversion to the mean play. Do not like the way FedEx looks here on the macro. We know, obviously, from the last couple times we looked at this, that back in 2015, when the 200 exponential and simple crossed the downside, when we went into the bear market, we went down to a low here that lasted quite a while. Again, we see the same thing taking place. We enter a bear market in 2018 and, lose from the entry of the bear market in confirmation. FedEx loses 62% of its value over the next year and a half. So I'm not saying we have to lose 62% of our value over the next year and a half. I'm just saying that we're in a giant megaphone pattern. We have broke down and confirmed a bear market, and the bottom of that megaphone pattern is 59% to the downside. So do we have to go down 59%? No, and there's plenty of stair-step areas along the way, but we have already confirmed the 236 from our low to our high. The next area that we would pay attention to obviously would be the 382 of our Fibonacci. But again, this looks very bad. We're obviously operating in a giant megaphone, and FedEx is basically a trash bag company. So and then PAVE next. This is that infrastructure play. So again, we're seeing a very clear topping pattern right here at a key Fibonacci extension level. I don't love the 1.786 level, but we're obviously seeing some confluence there. So we'll see what happens if this looks like a double top. I think more likely than not, it probably will be. We're seeing, again, bearish divergence, losing the slope line. So more than likely coming back down to the 1.618, retesting the 200 exponential and simple. All right, so let's get to the juicy stuff, the good stuff, the cryptos. But first, let's look at the dollar. So once again, the dollar jumped straight back up here, reclaimed the 8 and 21, and is just hanging out at it. So what have we been saying this entire time? This looks to me like a bullish reset. We're seeing price go sideways. The dollar has done nothing. It's just been going sideways for weeks. And where are the indicator oscillators? We went from all the way at the top of the range here at 90, all the way to the bottom of the range here at 22. So we're currently sitting around 40. So we went all the way from the top, all the way to the bottom on the indicator oscillator. And where did we go in price action? We went sideways. So what is that? That's refueling the jet. We literally are just coasting through the air right now, refueling the jet before we continue to the upside. Same thing with the MACD. The TDMACD, we see we're at the 0.6, basically 6 level right here. And now here we're back all the way down at 0, and the price has gone nowhere. We just went sideways. So now we have all this potential now to go back up. We have reset our indicator oscillators, and now we have all the potential in the world to just make another burst to the upside. So that's where we look for the confluence between our indicators and oscillators. We look for our divergence signals, and then that can tell us what the likely move to happen after this is. So what is this telling me? It's telling me the dollar is strong. The dollar has confirmed in a bull market on the daily, on the weekly, and on the monthly. The dollar is strong in comparison not to asset prices, but in comparison to the basket of currencies or other currencies around the world. So it tells me that if I was going to put my money in a country, in their goods or assets or stock markets or housing market or whatever, that all of them probably look bad right now, but the best one is probably the USA. So, but again, that's based on technicals, not my feelings or, what I want. So all the people that are saying China's a deal right now, it's cheap, everything's cheap, invest in China, invest in Russia, invest in Turkey. Sure, I mean, they're down. They're cheap compared to what they were, but does that mean you're getting a good deal? No, it does not. It does not mean you're necessarily getting a good deal. Just because something is down 50% doesn't mean that now it's a good deal. Because if it goes down another 50%, it's not going to look like a good deal, if you bought now. So I'm not saying there's not opportunity in emerging markets or foreign markets or whatever. But what I'm saying now is the technicals are telling us that somebody other than just us is thinking it might not be the best time to be diversifying into all these countries as they're all showing weakness in their currency in relation to the dollar. So if the dollar is going to continue getting strong compared to these other currencies, I'm going to keep my strong dollars. And then later on, once we start seeing the other currencies strengthen in comparison to the dollar, then I'm going to use my strong dollars to buy those goods at cheaper prices because the exchange rate is going to be higher for my dollars to buy those goods or services or, whatever, property, whatever it is you're looking to buy. So that's why the DXY is so important. So now let's transition into our cryptos and, basically we can see exactly what we said took place. So we threatened, this is our futures chart right here. We threatened and just to remind you, if you're just tuning in right now, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. So this is our Bitcoin futures chart. Like I said, exactly what we discussed in our last stream and have been discussing is taking place now. We see this entire time, basically, since we initially confirmed our bull market in April of 2019. We got on top of the 200 exponential and simple. We angled the slope to the upside. And then we had the little CVD scare right here where we lost the slope temporarily on the 200 exponential and simple. From that point on, from $8,000, these 200 exponential and simple have been big and bright and blue and angled to the upside. We threatened the 200 exponential right here. It flipped over red, but the 200 simple never lost its slope line. And now here we finally see the 200 simple has lost its slope. It has flipped over pink. The 200 exponential has lost its slope. It's flipped over red. And what did I say was going to happen? This is literally how Wall Street, this is how algorithms, this is how, the bots that are programmed by market movers, market makers, smart money, institutional money, this is how they determine trend. So right now, the trend has flipped from bullish since $8,000 to bearish here at $47,000. And the first move that we saw a lower close on the daily, on the futures chart, and then now we see this beginning of the move to the downside. So now again, we're going to pay attention to those levels we pointed out in the last stream at, basically like 42,000. If we threaten that level, we then have put in a high, then a low, then a higher high. So the last thing we want to do is take out that low right here, because then we'll have a low, then a high, then a higher low, then a higher high, then we'll have actually a lower low. So we don't want to see that happen. So if we just rally right here and keep moving to the upside, we can potentially save this uptrend. But we're confirming a potential bear market is taking place. This is the transition from a bull market into a bear market, and we're threatening that low right now. So if we now see a close below that 41,000 roughly, let's say, if we see a daily close on futures below 41,000, we will have confirmed a bear market based on our moving averages. We will have confirmed a potential downtrend by taking out our previous low. So now instead of looking at this as a higher low, we would be looking at this as a lower low. So then we have a high, then we have a low, then we would be looking for eventually a bounce and potentially a lower high, and then we would confirm a downtrend on the daily. Obviously longer than just this little downtrend we've been in. And then the next level to pay attention to, the next key level that we would absolutely need to hold is that 30,000 level. Because the last thing we want to do is take out this 30,000 level. Because when we zoom out, we see the same thing. We see a high, then we see a low. All this is part of that same move. Then we see a higher high. So we have a high, a low, a higher high. So the last thing we want to see now is the low of the macro get taken out. So this is the low of the micro of this move to the upside. This is the low of the macro of the entire trend. So if we threaten this and take it out, it looks bad. If we threaten this and take it out, it looks really bad. And then we start paying attention to like our key fib levels and potential like downside targets. So obviously we have, I think I only have the one fib in place right now, but this was our Fibonacci extension from the all-time high, basically giving us that 1.618 target, which we tagged perfectly. So that's from the all-time high and the inception of futures, the 20,000 top in 2017, to the low of the bear market right here. This is our 1.618 Fibonacci extension, which we tagged literally perfect to the penny. And now we're potentially topping out. And now we're finding at least some short-term support at the 1.382. If we lose that level, we would expect a 1.236, etc. Now that we are potentially topping out, we can also draw a fib from our macro low right here to our macro high right here. So we'll put that one in green. And then that 1.236 actually lines up with our 236 of the upside target. So we're at the 382 now. So our next target to the downside is our 236 of the move up here in green. Matter of fact, I'm going to turn the yellow one a little less bright, and then I'm going to turn the green one a little more bright so it's clear. So now that's our target to the downside for our next move. Once we violate, if we violate, should we violate, that previous low. So the next level to pay attention to is this low around like 41,000. If we break through that, our next area to pay attention to is the 236 and this previous support level, which also lines up with the 1.236 Fibonacci extension. And then, of course, we just keep stair-stepping down and looking at these key fib levels. And we would expect, if we do come down here and touch this, we would then expect to push back up and then potentially that lower high that we were talking about, at which point in time we would confirm we're potentially going into a down, trend. We would see, can we reclaim the 200 exponential and simple? Can we flip that back over bullish and avert the bearish downtrend or bear market? If we can't, we get rejected, we put in a lower high, we come down lower, and we just look at our next target to the downside, which again would just be our stair step down, which in this case would be the 382 of the macro, move from basically 3,000 up to 60 something thousand. So do we have to go into a bear trend right now? No. Do we have to go into a multi-year bear market right now? No. Does it look more likely than it has ever looked since we went into our bull market? Does it look like where the 4-year cycle is playing out exactly as we discussed? Does it look very, very likely that we are looking at a bear market as we have never gotten a false signal ever on the Bitcoin futures chart, and now we're signaling a bear market? Yes, that's exactly what it looks like. And again, even the CVD dump right here, when we signaled the bear market and we confirmed it, it wasn't that violent of a move, but here we flipped the 200 exponential and simple to the downside, and we immediately had a 50% move to the downside. So assuming the minimum is a 50% move to the downside from the confirmation, only based on that one level, because obviously we don't have that much data, that would give us roughly our target of the 382, which is 21,000. And then, of course, we would expect the 21,000 level to hold because we have never violated the previous all-time high of a 4-year cycle. If we were to hit that level, I would expect a powerful bounce the same way I would expect a powerful bounce to the 236. So while I'm not saying that we have to go lower or that we need to go down or that we have to go into a bear market, what I am saying is the probability right now of a bear market is higher than it's ever been. It's higher than it's ever been in this entire bull cycle. So if our A comes down to the 236 and then we get a bounce back to the upside, we'll have the 200 exponential and simple coming down here. Maybe we bounce at the 1.382 and then we see continuation to the 382. Maybe we push back up and actually get above the 200 exponential and simple, flip them back over temporarily bullish, and then it gets rejection and we go down to the downside. Maybe we reclaim them and we go back to the upside. All those are possibilities. But we need to look at the actual likelihood of what we're seeing here and say that at this point in time, what was a 20% chance of a bear market is now a 50% or 60% chance of a bear market. So when we come back up here, if we can reclaim the 200 exponential and simple, the odds will flip and there'll be a more likely possibility of the bull market, being intact and continuing to the upside. If we get rejected right here and start to see continuation, the odds will go to, 75%. If we take out this low right here, we'll have obviously, there's no denying we're in a bear market at that point in time. But I do fully expect, threatening this 30,000 level or $33,000 level and potentially the 20,000 level. So could I be wrong? Sure, 100%. I could definitely be wrong. We could definitely save this level and go back into a bull trend. We could literally today shoot straight back up to $54,000, and I would not be surprised at all. Not even a little bit. But it's very clear by this chart that the bears are in control. We are seeing for the first time this entire trend to the upside. We are seeing the bears are very much in control. Throughout the entire bear market here, we see a bunch of areas where we're in the bearish control zone, which is this green highlighted area in the background. It's literally telling us the bears are in control. Then we see a couple times where the bulls are in control here. That's the absolute top. The bulls are in control here. That's the absolute top. The bulls are in control here. That's right before capitulation. So the 3 or 4 times when the bulls take control, we sell the rips. We sell those rips. And the same way, once we're in a bull market, we see the bears are almost never in control. We see the bulls are in control anytime it's in the red. And then here we kind of go sideways, have that little COVID dump. And then this whole entire trend to the upside, once we're above the 200 exponential and simple, and we're in a bull market, what do? We buy the dips. Every time we see a dip, if we get down to the green area, we buy it. If we get down to the green area, we buy it. And now what are we seeing again? The transition taking place. The flip. This is where everyone loses all their money. It's easy to trade with the trend. When everything's going up, everyone looks like a genius. When everything's going down, everyone that's shorting looks like a genius. When there's a transition between a bull market and a bear market, or a bear market and a bull market, if you don't get hip to it, if you don't realize the transition is taking place, that is where you lose all your money. And that's exactly what's happening right now. And that's exactly what's going to happen. If we go into a bear market right now, damn, the bots are out. Ooh, bots are out today. Got that bot army in full effect. Let's go. Dear God. If we, confirm and we do go into a bear market right here, I promise you that many of the people that made hundreds and hundreds of percents of gains are now going to lose them faster and end up with nothing. And the worst part is many of these people will not have set aside money to pay the taxes on the gains that they made. So they're actually going to be net negative. So we'll see it happen. I promise you that. If we do go into the bear market here. So that's why it's so important to pay attention to what's taking place. So let's look at the weekly, and then we'll continue through our cryptos. But we're actually going to take a little break just from a straight up TA, and we're going to take a look at the new juicy indicator. So here is our futures chart on the weekly. Again, we see the confirmation of the 8 and 21 to the downside on the weekly, confirmation of the 8 and 21 to the downside on the weekly. We see the hard sell and exit the bullish control zone. We see the hard sell and exit the bullish control zone. We see a bunch of red histograms, We lose the slope line, it flips over red. We lose the slope line, it flips over red. We see bearish divergence. We have a high here. We have a higher high here. We have a high here. We have a lower high here. We have a high here. We have a lower high here. So we're seeing bearish divergence on the weekly, and every single bit of every one of our indicators is bearish right now, with the exception of we're still above the 200 exponential and simple on the weekly. So I'm not saying we have to go into a weekly bear market for the first time ever in Bitcoin futures chart history. But what I am saying is the likelihood of a reversion to the mean or potential retest of the 200 exponential and simple is higher than it has ever been this entire bull cycle. So where is that at? Right around 20,000. So that's what I'm paying attention to. Yeah, I know the bots are fucking crazy, bro. Good to see you there. Good to see you, Christoph. How you doing, man? Sorry I missed your message. Maybe I answered it already. Comb Concept said, late to the stream. Damn these bots. Yeah, you're not kidding, bro. Quick analysis on ETH and alts. Yeah, I'm going to do the analysis on ETH and alts, but I'm actually going to take a look at the new indicator. You know what I could do? You know what I'll do? I'm going to skip over the Bitcoin spot chart, and then I'll just do ETH and alts first, and then we'll come back to the indicator. So Ethereum, again, I mean, this is, if there was ever a time to be cautious in Ethereum, this is it. We were in an ascending channel this entire way up from our low down here, from our double bottom at $89, which, I was picking up my Ethereum in the high 80s. Okay, we went into a macro uptrend above the 200 exponential, above the 200 simple. They're blue the whole time. We're in a very clear bull market inside of this channel the entire time, with the exception of this little poke out the top right here. And now what is going on here? We have broken down from that channel, and then inside of it we have a tiny little descending channel, and we have broken down from that channel as well, and we're sitting on top of the 200 exponential, and we tagged the 200 simple. So if ever there was a time to be worried about your Ethereum and a potential bear market, this is it. So I laid out the targets in the last stream basically, and they're not good. If we lose the 200 exponential and simple, which we are still above them, and they're still blue. So Ethereum is much more bullish than most of the alts, than Bitcoin itself, but we're definitely in the danger zone. And if we just look at, there's a lot of different ways we can do it. We can fib from this local low right here at 1700, and we can get some immediate targets, and see where that's at. We can fib the entire cycle, which is what I'm inclined to do. So going all the way back here to when we entered into the channel, to the macro high right here. And that's the areas we're really paying attention to. And again, we're seeing very clear confluence that is worth noticing, that the 236, before we put in our macro high, this tells you that the bots and the algos have a predetermined level that they want to move price to, because we can see the confluence that takes place the whole way up. We see a very clear resistance at the 618 way before we ever have a macro high. We see support at the 382. We see resistance at the 0.5. We see very clear resistance and then support at the 236. The level of confluence we're seeing on this green fib right now for the cycle tells me the likelihood that Ethereum has topped out is extremely likely, because everything is lining up perfectly. So when we come down here, the initial main target, we obviously have a stair step. We have these previous lows right here, that we would expect to act as support, at least temporarily. So we want to pay attention to like 2,775. We would expect that to act as support. But in all reality, the key level we're looking at, if we see downside continuation, which we don't have to, maybe Ethereum just bursts to the moon and everything else goes down, but Ethereum goes to the moon and it's all bullish. But the target is the 236. And we see very clearly resistance, resistance, support, support, support. And that is our macro 236 for the trend. And that is at $1,875 roughly. So, that is literally like 50% down from where we're at right now. The next level after that would be the 382 at 1,046. So again, I'm not saying we have to go there. I'm not saying we're going there tomorrow. I'm not saying there's no way that Ethereum can go up from here. But if we see this bear market confirm and start to sell off, these are the key levels we're paying attention to based on the macro fib. So, and again, Ethereum looks better, but it does not look good right now. Losing this ascending channel and losing this descending channel is not good. And now here we're potentially flipping the 200 exponential red right here, and we're just above the 200 simple. So if we lose this 3,400 level, all we do is just go sideways under 3,400 and we confirm the bear market and we see continuation to the downside. ETH Bitcoin ratio, just going steady right now. Not really telling us much right here. Total market cap, doing exactly what we discussed on the weekly. So again, we came up exactly to the 1.618 Fibonacci extension right here from the previous all-time high from 2017 to the, well, technically 2018 because the alts ran a little longer, to the low right here. And then the Fibonacci extension literally comes up exactly to the 1.618, exactly like Bitcoin did, doing the exact same thing. And then once again, we see bearish divergence on the weekly between this high and this high. And now here we're getting ready to cross once again the 8 and 21 to the downside here. So if we do not get above 2.26 trillion in total market cap, we confirm the 821 cross to the downside on the weekly. Maybe we save it like we did back here. Maybe we see that continuation, but more likely than not, and the key areas we'll pay attention to are this support level at 1.2 trillion, and then the 200 exponential and simple, which are at 949 billion, and 704 billion. So those are a ways away. It's not going to just happen in one candle, but I'm telling you, what is your crypto going to look like if we go from a $2 trillion market cap to a $1.3 trillion market cap? It's not going to look good, I'll tell you that much. And what if we go to a 1 trillion? What if we go from a 2 trillion to a 1 trillion? Chances are your favorite crypto is going to be cut in half or much, much more. So be very careful. Bearish divergence, hard sell signals, leaving the bearish or bullish control zone, bearish divergence on the TJD TDMACD, slope line has flipped over red, 821 are confirming. This looks very, very bad. So you want to see what pain looks like. $1 trillion cut from the market cap is going to be very painful for a lot of people who were over leveraged. So Bitcoin dominance chart, again, we see the opposite here on the Bitcoin dominance chart. We see triple bullish divergence. So one drive, two drives, three drives, one low, one higher low, one third potential higher low. And it lines up perfectly with our descending trend line support. So if we bounce this level right up here, potentially move back to the top of the range. If we break out, essentially this is just showing us that Bitcoin is likely to gain strength in relation to the altcoins. So if the market cap looks bearish and looks like it's going to go down, and this looks bullish, this is telling us that when price goes down on crypto, if price goes down on crypto, which looks likely, that Bitcoin is going to gain strength compared to the alts. So we would reason that Bitcoin's going to go down, but alts are going to go down much faster. Therefore, they're all going to go down, but Bitcoin is going to gain market cap because the alts are losing value faster, or Bitcoin is holding its value better. So that's what we're paying attention to, and the confluence and what these charts are telling us. So let's rip through these alts real quick, and then we're going to look at the new and juicy indicator. So Polkadot, basically at support right now, holding on for dear life. We do see blue on the slope line of the TJD TDMACD. Doesn't look great right here. Does not look great. If we lose this level, it's going to be under some serious pressure. So the initial target to the downside we have to look out for is just that like local low. So if we break down from here, that's what we're looking at, $24. We took a little stab at this. It was looking okay, like it was going to reclaim these levels today for a quick little scalp. And unfortunately, it did not happen, ran out of steam, and brap, that was a wrap. So losing this neckline right here, if we close below this, is going to definitely come down and retest this level. If this holds, we could easily still move to the upside. We do have momentum in our favor here, but it doesn't look great right now. I mean, crypto looks far from strong. Let me put it that way. I mean, but it hasn't for a while. We've been talking about this literally for a while, how weak crypto has looked, and that the majority of cryptos are below their 200 exponential and moving average and simple moving average on the daily. That's terrible. So we had a nice scalp play out on Chainlink. We had the inverted head and shoulders. Entered this one in the group at 22.88 roughly. We had the initial target play out, which was a about 18% move to the upside at that 26.89. We trailed our stop up on the way, and then obviously we got rejected at 200 exponential. Pretty bearish looking candle so far. But if this level holds right here, I'll probably just scalp it right back to the upside again and look for that potential continuation. So again, momentum in its favor, trying to reclaim the 200 exponential and simple. It did flip them back over, at least temporarily, so not dead yet. If we come back down here and retest the 200 exponential, the top of the inverted head and shoulders, and this holds, I'll take this scalp again and take another shot at it. So, but when it was all said and done, not a bad little quick, basically, what was it, like a 1 or 2 day? Like, I think by the time we ended up getting out of the trade, it was like over 15% move in a day, while everything else did nothing. Like, what other cryptos exploded to the upside 15% today? I'm sure there were other ones, but, we nailed this one for sure. Uniswap, rejection from that level. We had talked about how, this isn't necessarily a favorable trade setup in the last stream. But it basically did exactly what we said. Even if you did take this trade setup, it wasn't bad at 7% stop with 20% upside, but doesn't look good. I don't like this. It's very clearly in a bear market and very clearly weak. Uniswap is very much out of favor. XRP still looks like total trash. Clearly in a bear market, 200 exponential and simple, very clearly to the downside. We're potentially losing the support level. Now, could we reclaim this and move back up here? Yeah, I think we probably do. I think probably crypto goes sideways and maybe pushes back up here, but I would not be surprised if all of a sudden tomorrow, XRP is at 51 cents. It would not surprise me one bit, but I also wouldn't be surprised if it was at 95 cents. So right now, XRP has basically a 50-cent range, and it's at 77 cents. So it's basically smack dab in the middle, and it looks like crap. I mean, it literally has not put in a new high this entire bull market. So when something puts in a high, and then goes a 4-year period and a massive bull market where everything else puts in new all-time highs and it doesn't, what do we call that? We call it a dead heartbeat. We call it a dead asset. We call it a dead cult. So XRP is absolutely terrible. One of the worst cryptos with the biggest market cap, which is not surprising. Not surprising at all. ADA, Cardano, and I'm not just being mean to XRP. I mean, the truth is, if you're in XRP and you rode XRP up and you loved XRP and you're part of the cult, look at what your gains are and then look at like any one of the other cryptos, if that would have been your cult that you were in, and look at how much more gains you would have made. Everybody that was hardcore XRP that rode it up this bull run made almost no money in comparison to anybody else that bet on any other crypto. Like literally any other crypto, and you made exponential gains. And you know, if you bet on XRP, you still live in your mom's basement. ADA, Cardano, again, bear market, looks absolutely terrible. Below the 200 exponential on simple, pathetic attempt to push back to the upside, could not even break above the descending resistance line, and now we're losing key support. So we're putting in a new low, threatening our, you know, we have a pretty nice base that Cardano carved out on the way up here, and now we're threatening that low. So, or potentially getting ready to threaten that low. So we really got to look out. There's some pretty crazy wicks here on the Kraken chart, but you know, essentially between $1.05 and 95 cents. So call it $1. We really want to see this hold that $1 level. If it loses $1, it's going to be in big trouble. And then obviously we can pay attention to like the macro fib, which the 236 is right around like 91 cents. But again, you know, Charles Hoskinson going live and telling you about his like fantasy dreams and how great Cardano is, and crying on live streams because his, you know, precious little crypto is getting delisted. It's only going to work for so long. Only going to work for so long. Sushi, so it did exactly what we said, came all the way back up, retested 200 exponential on simple and failed. You know, again, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research, trade responsibly. But I literally told you I would be getting out of sushi 100% right here at the 200 exponential and simple. And again, this was a request, you know, from peak to trough, obviously down 29%. You know, so I guess I was right on that one. Clearly a rejection of 200 exponential and simple. Clearly entered into a bear market, or re-entered into a bear market. Technically, it was in a bear market this whole way down. This was our reversion to the mean, attempt to save the bear market, and it was rejected. So at this point in time, sushi looks like continuation to the downside. Looks like it is going to get aggressively wrecked to the downside. So basic attention token, still much stronger than most cryptos, but looking pretty toppy right here. We have the 200 exponential and simple, still well above them. Definitely the best chart we've looked at today so far for cryptos. But this looks really head and shoulders-y. You know, we have like some weird little double shoulder here. We have a head, a neckline, pretty well defined here. And then we have a weird little, you know, right shoulder right here. So if we break down from, this chart is so busy. If we break down from this neckline in blue, basically, you know, which is $1.06, you know, I would expect to get the measure move to the downside, or at least retest, you know, this green trendline support. So we have a very clear blue trendline support. We have very clear, or neckline, very clear green trendline support, and then the 200 exponential and simple right smack in the middle. So stair step its way down here, but we're looking at, you know, to the downside, $1.08, then potentially $1, then somewhere around like 87 cents, and then the last line of support is around 84 cents. So, but basic attention token does look stronger than any other cryptos we have looked at so far. HTR, once again, Hathor looks very strong in comparison to the other cryptos we've looked at today. We were talking about a potential inverted head and shoulders, came all the way back up to the neckline, which is where we would expect a potential break in continuation, but it did in fact fail. Coming back down, threatening the low. If we lose this right shoulder right here, it's going to look bad. It already does not look like it's going to play out. More likely than not, this is the last line of support. If it breaks down from $1.55, we'll start looking at the moving averages. So $1.18 and then potentially $1. Again, these things don't have to just start selling off to support, but we really got to start paying attention to these levels. And it's very easy to define the level to the upside. You know, we need to take out the local high. If we don't take out the local high, we're going to revisit the local low. And then whichever way we break in, we start looking at targets to the downside or to the upside accordingly. So we were talking about Matic, and this was our potential area of interest. So we've had this ascending wedge basically, and every time we have bought the bottom of the wedge, we've had a nice trade off of it. And now here we are at the macro 786 and the bottom of that wedge again. So we hit our target as expected. We got the 821 cross to the downside. Every other time that's happened, price got picked up off of that green or blue support line. So, is it worth taking a shot here? Maybe. I really got to see what's happening with the rest of crypto right now, because this could be, usually the more times you get a free trade like this, an easy trade like this, the less likely it is to play out again, because everybody sees the same thing. So, while I would expect support or resistance to hold, the more times we keep bouncing around them, the more likely we are to break, because eventually we're going to break. So is this going to be the one time when we break down, we tag the 200 exponential, tag the 200 simple, and touch that 618 target? Maybe. $1.65. Again, this one is much more bullish than the rest of the charts we've looked at. Bunch of red histograms, hard sell signal, come out of the bullish control zone. So we'll see what happens. If it starts to form a base right here, I will probably scalp this again and take a scalp to the upside. I mean, roughly 30% move back to the upside, and I think we could easily run, somewhere between a 6 and 10% stop loss. If we break down and start closing outside of this range, we get stopped out. If we get that move to the upside, we obviously get like a 5-to-1 risk reward ratio from basically where we're at right now. So I think running a like 6% stop loss roughly, or if you want to be conservative, 6%, you want to be a little more aggressive, maybe 10%. But realistically looking for a daily close below that, and then looking for a potential move to the upside of like a little over 30%. So clear out these. Obviously we did not hold our potential breakout right here, so those were never actually valid, but that would give us over 5-to-1 risk reward ratio with a target of $2.84, a stop loss just below $2, and a entry price of where we're at right now at like $2.15. So, and I believe in the group I said, I can't remember, somebody was asking me about Matic specifically, and I was talking about the technical analysis and how we were looking for like 213 as our target for an entry price, and it looks like we came down right around like 2 to 213, somewhere around there. So potentially this is the area we're looking to re-enter Matic for a scalp. But again, we got to really see what's going on with crypto right now, because we're confirming basically that we're in a bear market. So we want to stop buying the dips, or be less likely to buy the dip, or more quickly to exit our trades. As the more we confirm into a bear market, the more we want to be selling rips and not buying dips. In a bull market, we want to buy the dip and ride with the trend. In a bear market, we want to sell the rip and ride down with the trend. AVAX, Avalanche looks pretty bad. 821 crossing to the downside. So the key area we're paying attention to here is $80. That's our previous support right here. 80's got to hold. There's a little bit of support at like 93, but looks pretty weak. Solana, same thing. We broke down from this target right here. So we have the 200 exponential and simple at 132. So we want to see 132 hold. We have a little bit of support. I mean, we basically already bounced the support at like 144. So looks like it's going to head down to 132. If this starts getting bullishly bought up right here though, and the daily support right here holds, this could potentially be a double bottom. So we could easily wick down here, or maybe it already wicked down. It gets bought back up, and then we leave behind just a wick, and then we get a nice green juicy candle and move back to the upside. And this was just a double bottom. That is definitely a possibility. Definitely a possibility. So maybe there's something there. Bears are clearly in control. Last time this happened, it got bought up. But again, we have to see at least like a green histogram or some kind of strength off of this thing. But it does look like it's headed down to 132. If this holds, it probably does bounce straight back up to 170. So there's not really a trade there. Micro strategy. Oh, Mikey Sailor. Oh no. Oh no, Mikey. Headed down to our target as expected, as predicted, as discussed over and over again, while Michael Saylor gets around and pumps his bag and buys $50,000 Bitcoin by the thousands, upping his total cost to over 30,000, and once again making a poor entry. Well, I mean, he's down on his recent entry, but still up on his position, as it is like his cost basis is about a little over 30,000. So that's the area. If we see Bitcoin breaking down below 30,000, we know there's some serious potential dumpage if Michael Saylor capitulates and realizes that he was wrong and all the marketing campaign he was running is not working. I would be pretty scared right now and definitely sweating if I was him and I had, $4 to $6 billion in Bitcoin and it was confirming a bear market. I would probably be sweating just a little bit, especially if my stock already confirmed a bear market and is capitulating and down from its recent high of 1,300 and it's at 500 right now. So let's keep in mind that MicroStrategy, which is supposed to be a proxy for Bitcoin because it's a trash company that literally does nothing, and it's down 61% from its all-time high. So it's much worse than Bitcoin, and its only value is derived from its purchases of Bitcoin. And it is in a bear market, and Bitcoin is confirming into a bear market. So look out below, okay? Because if we come down here and break through 411, you guys know like 345 is my next target. So MicroStrategy looks like trash. Michael Saylor is a scammer piece of shit. If you don't believe me, Google him. Google Michael Saylor MicroStrategy 2000.com bubble and read up a little bit. Hood looks terrible. This thing is on a fast track to zero. This got to be Vlad just dumping lower lows. It's going straight to zero. Okay, maybe it finds some support along the way, but it's on a fast road to zero. So Coinbase looking like trash, obviously, breaking down from support. It could still rally from here. It could still find support. It's going to do whatever Bitcoin does, whatever crypto does. But I'm telling you right now, if we break down from this level, we don't have a lot of support here. We basically have like the 226 level, and then we essentially have like that 206 level. And this is just a proxy for crypto. If crypto goes into a bear market, Coinbase is going to get absolutely wrecked. It's a total shitty company. It's total garbage. The one job it has to let people trade crypto, it cannot even do. The exchange crashes when there's volatility. So when you go to trade your crypto, when Coinbase starts, if Bitcoin starts pumping or Bitcoin starts dumping and you go to trade on Coinbase and it doesn't work, keep that in mind when you hear people say that Coinbase is a good investment. Sure it is. You have one job, Coinbase. You have two jobs. Don't get hacked and let people trade crypto on your exchange. And you fail constantly at one of them. And, I don't know if you've been hearing the news articles lately, but sort of failing on both of them. But I'm not going to fudge your Coinbases. So the meme trash bag stocks, Bed Bath & Beyond, new low, going much lower, total trash, headed down here to less than $10. Going down to single digits, Bed Bath & Beyond, total garbage. AMC, threatening the low here once again. If we take out $20.83, AMC goes straight to zero. Probably stops off at about $14. So this thing looks like total trash. Very, very close to confirming a bear market. 200 simple is still technically angled to the upside. This looks like total shit. AMC is such garbage. GME, bear market. Below the 200 exponential and simple, both rolling over. New local low, total trash. GameStop is garbage, is a useless garbage company, and the CEO is literally dumping on your head. He's taking a steamy dump right on your head. Right now. It's literally happening as we speak. I'm watching it happen in my imagination. And it's gross. It looks like shit, and it smells even worse. So AMC, GME, meme stocks, dead, garbage, done. Get out. Not financial advice though. Or just go all in. Buy the dip. Buy the dip. That's probably a good idea. Not financial advice. DraftKings, total trash. New low. Total garbage. No support. There's nothing to even hold you up. Your next support level is at 1886. So DraftKings, straight to zero. Bear market. Total garbage. All right, we did it. So let's take a look at the juicy indicator. Oh yeah. But quickly, I'm going to jump into chat and see what you guys have to say here. Comb Concept. Already got that one. Bonbon says, hi, first time commenting. Great stream. Thank you. Would like to join the group, please, but not sure how to. Awesome, man. Great to hear. If you, man, this is the best time ever too, because you're going to get a brand new indicator as well. There's a email address in the description of the video. You can just send me an email. Another bot. What's up? Bot army is always strong. Gotta love these bots, man. I mean, it's so crazy. It's like YouTube is able to like ban comments if they say stuff that they don't like about like presidential parties or use words that we don't like, but somehow can't ban bot or links that are clearly trying to scam you. That's so weird, huh? Comb Concept said XRP holders are still banking on it. Be relisted on Coinbase. Terrible. Yeah, poor XRP holders, man. Poor XRP holders. They're just, once you drink the Kool-Aid, dude, it's a slow death sometimes. It doesn't just always kill you immediately. And that's exactly what's happening to the poor XRP holders. I'm all in on XRP. Oh, man. Everybody else got rich but me. Comb Concept says, let's get Matic pumping. Yeah, maybe, man. I mean, there's a couple cryptos that still look good. So as we see some relief rallies, which we will see on the way down, we don't just go straight down. We will see dead cat bounces. We will see key levels of support holding. We will see, short-lived rallies, regardless if we go into a bear market, especially if we save the bull market. But the ones that have been strong are likely to be the strongest. So when I noticed the strength in Uniswap, that's why we took that scalp, and that was nice. We see basic attention token is strong. We see Matic is strong. We see whatever that one HTR is one of the stronger ones. There's a couple other ones too. I can't remember what the other one somebody asked me about in the group was. But it looked weak on the short term, and it's a good thing I said something too, because I think it's down like freaking 10 or 20% since then. But it looks strong in comparison. I'm sure there's some other shit coins that look strong too that I don't look at. And if you ever have requests or whatever, feel free to ask. Let me know in the comments ahead of time, and I'll be glad to look at them on streams. And for anybody new, we do stream every single Wednesday and every single Sunday from 8 p.m. till roughly 10, 11, or 12, depending on how many assets we have to look at, how many rants I go on, or how much like exciting stuff there is to talk about. But speaking of exciting stuff there is to talk about, I wasn't necessarily expecting a big move in crypto and stocks and yields today. So I have been working very hard on an indicator, a new version of an old indicator, and that is the Jewel Thief. So you guys know, obviously, the TJD Master is offered exclusively to group members, as a thank you for showing their support to me. All the rest of the indicators are free. If you have not downloaded those, you can get them available in the description through TradingView and use them as much as you want. But today we're going to take a look at the, I'm not sure what I'm going to end up calling it. Maybe still the TJD Jewel Thief, maybe just the Jewel Thief, maybe something else. But right now it is, in the meantime, just nicknamed the TJD BNE. And essentially what we got going on here is, so how do we want to do this? Let's turn off the other, well, we don't need to turn that one off. Let's get rid of the MACD. Well, I don't even think we need to mess with it. We can just make this a little bigger, and we'll just pay a little closer attention to what's going on here. So essentially what it is it's everything you guys have been seeing me do on my version of the Jewel Thief for some time now. I know that the various published versions I have, some have the RSI, some have the knife, some have the bullish and bearish control zones, some have hard buy and sell signals, but none of them have like all the aspects together. So basically what I've done is like fine-tuned this bad boy to be absolutely phenomenal. So for anyone that's already using the Jewel or the Jewel Thief, or even the Stoch Slope, you guys obviously know how well they work. This is exponentially better. And now we're going to talk about how and why. So there are multiple components of the BNE that we pay attention to. So essentially we have our stochastics in blue and pink, and then we have our knife, which is green, and then flips over to red. And obviously we pay attention to the crosses on the stochastics, as well as the levels where they're at, either in the bullish control zone or bearish control zone. And then with the knife, we pay attention to the color of it and the aggressiveness of the point. So when we see the knife sharp and pointy like that, we know that we're either at a macro high or we're about to put in a divergence, and that will be our macro high. So whenever we see a big stab like this to the upside, that's either our high already, or we'll put in a bearish divergence, and that will be our high. So we always pay attention to either this is the high or right afterwards we're about to get a high. Same with the low. When we see an aggressive knife stab down like this and it's red, that's either going to be our macro low or we'll get a bullish divergence and then burst back to the upside. So, and then obviously we have two different varying levels of buys and sells. So we have our hard buys, which we see here in blue. We have our hard sells, which we see here in like this purple color. And then we have like a hard sell that is like a little more like pink. And then we have the actual S signal right here, which we can see like a little more clearly when we zoom in, or the B signal right here. So we have our hard buys and our hard sells. We have our bullish and bearish control zones. We have the strict criteria, hard buys and hard sells with the corresponding S and B signals. And then we also have our bullish and bearish control zone. We have the stochastics with the crosses. And then we obviously have the knife as well. So that is like essentially the composition of the indicator. So now let's take a look at each little part and we can kind of break it down. So I'm going to look at the settings right here. I'm going to go in here and you have the ability to change not only the colors of all these things, but also turn on and off any of these things that you want. So essentially, I'm going to turn everything off but the stochastics right now. Whoops. Sorry, I went to the wrong spot. I want to turn off the knife right here, but I want to go to the inputs and turn off all of these. And then we can go through and look at each one. So here is just the stochastics alone in blue and pink. And then we see here, obviously, we have our clearly defined bullish control zone and our clearly defined bearish control zone. So the solid blue line is the bullish control zone. It means the bulls are in control. It's their territory. They're in charge. The pink line down here is the bearish control zone. Once we're below that, that means the bears are clearly in charge. And then we have like our max level, which is 100. The only thing that can operate outside and then 0 on the bottom. The knife can operate outside those levels, but the stochastics cannot. They obviously max out at 0 and 100. So that's our stochastics. Now what we do is we use the crosses of these stochastics to determine basically our, buy levels and then also obviously the control zones. So if we click the first one here, that is highlight control zone, that will turn on the bullish and bearish control zones. So we'll notice that the background will light up when the bulls are in control as soon as the blue stochastic enters above our predefined bullish control zone, and then it will light up green as soon as it lights up, goes below that 20 level or our predefined bearish control zone. And same thing when we exit that level. As soon as the blue comes out of the 80 or bullish control zone, it unhighlights the level red, and then same thing with the green here as soon as we leave the control zone. And we have the ability to change the control zone, so we could set the bullish control zone at 90 and the bearish control zone at 10, so we'll get less areas where it lights up red or green. So it's more of a strict criteria. That way we get less signals, but the signals are more reliable. Or we could do the opposite. We could switch them to like 70 and say 30 instead of 80 and 20, and then we would get more areas where the bulls are in control, more areas where the bears are in control, but the areas are less reliable because the criteria is broader. So that's, basically the bullish and bearish control zone and how those operate. And then the next thing we're going to do is we will look at, I'm going to turn off the control zones, and then I'm going to turn on the any cross signal. So what this is going to do is this now will highlight any cross. So when we have a bearish cross, it will be in this like pinkish color right here. When we have a bullish cross of the stochastics, it will be in this bluish color right here. So there's no criteria on these crosses. So every time the blue crosses below the pink, it gives us a red or bearish cross signal. Every time the blue crosses above the pink, it gives us the blue or bullish cross signal. So obviously that is pretty simple. So, again, it's less reliable because it's anytime it crosses. But here it would give us a sell signal up here. Here it would give us a buy signal right here. Here it would give us a sell signal right here. So we see this buy signal was not the best signal. This sell signal was not the best signal, but this one was. So again, it's less reliable because it's any cross. So it does not take into account the level that it's crossing at, but it works great for scalping on short time frames, or even swing trades on longer time frames as well. So and then we have the buy and sell signal, which is just basically the same exact, you know what? I'm going to turn off the any cross signal, but you'll see that it puts the B and the S in the same place exactly. So all it is it's literally just giving us a hard S or a hard B wherever it lights up that zone. So it's not giving us anything different. It's just giving us, an S or a B instead. So you could use them together. You could use them one instead of the other. If you only wanted the S and the B's, or if you only wanted the highlighted area when they cross, or you could use obviously both together. So all it does is just tells you buy the cross here, sell the cross here, buy the cross here, sell the cross here. Again, remember, this is not financial advice. I am not your financial advisor. These markets are extremely volatile. Please do your own research. Trade responsibly. But next we have our strict cross signal. So now I'm going to turn on the strict cross signal, and we'll see that there are much less of these. Okay, the reason there's much less of them is in order for the criteria to be met, it only gives you a hard sell or a hard buy signal when the cross takes place above the bullish control zone or below the bearish control zone. So these signals are much less common, but much more reliable. So we know for a fact that what are we looking for? Well, we're looking in a bullish uptrend. If we want to trade with the trend, we're looking to buy the dips. And in a bearish trend or a, bear market, we're looking to sell the rips. So in this case, the entire way up on the daily, we never see a hard buy signal because we never actually get inside the bearish control zone and have a cross to the upside. So that's not the best thing to do when you're trading with the trend, because it's very hard for the bears to take control and get both stochastics down in that level and then have the cross back to the upside. So in this case, it makes it difficult to trade with the trend with this strict criteria. So if I was just going to use this, for instance, I would alter the bullish or bearish control zone accordingly, whether we were in a bull or bear market. So in this case, we have the bearish control zone at 20. If I was going to use this signal effectively to buy the dips, I would want to move the bearish control zone up higher. So for instance, I would probably put it somewhere around like, say, 25 or 30. So I would go to either the bull CZ or the bear CZ, which is obviously control zone, and then I would alter it up higher until I started getting signals that I like. So here at 25, now I can see, again, I want to ignore the sells because I'm going to trade with the trend. I'm not looking to sell. I'm looking to buy the dips. So now where do I have those triggers at? Well, now at 25, I get a hard buy signal down here, which would be a beautiful buy. I get a hard buy signal right here, which would be a beautiful buy. I get a hard signal buy right here, which would be a beautiful buy. I get a hard buy signal right here, which would be a decent buy. But now here we got to look, we're potentially crossing into a bear market. So the same way that we're going to get a couple sketchy signals right here, where we're crossing between bull and bear market, same thing here. But when we're trading with the trend, just for an example, we can see from where we get the hard, oh, I may be blocking this with the, sorry about that. I forget I have the computer screen over there sometimes. So sorry if I was blocking that. We get the hard buy signal right here. It basically gives us a, move afterwards, depending on where you're going to, till the next signal or until we get basically into a bear market, depending on how you want to look at it. But we basically have, a 1000% move after that hard buy. So, depending on how you want to look at it, maybe you want to go to just the first hard sell signal and you want to take some profits, you have a 75% move with 100% accuracy on that one. Then the next hard buy signal, if we take it at 25, we buy right here. And then until we get the next hard sell signal, you're looking at roughly 26%. Maybe you want to go till, the top or whatever, but, we're essentially looking at a 500% move to the upside. So obviously you have to pick what your criteria are going to be. You have to pick how many of these you want, hard buys or hard sells. Here we have again, basically at the absolute bottom right here. And then again, if you want to go till the first hard sell signal, you're looking at like a 15% move. If you want to go to, various levels, the cross below 200, peak to trough, etc., you have 100% move. So, but again, if you're buying into the trend, if you're trading with the trend or accumulating or investing in an asset based on this hard buy signal in a bull market, you're not really looking to get out of the asset. You're more looking at where you add. So you're looking to buy and not really looking for targets to sell until we transfer into the bear market, and then you're looking to exit because now you want to start selling the rips instead of buying the dips. So the same way that we see that transition taking place, if we do go into a bear market right here, which looks possible or likely or whatever, we're then going to do the exact same thing, but the opposite version of it. So instead of switching the bearish control zone to like 25 to get more signals, maybe we want to switch the bullish control zone to 75 so we get more signals. And we can look back at the last bear market and see, basically, would that have worked? How effectively would it have worked? So we can see here, we get I should show you before I modify it actually. So we get actually a couple signals here. We get the hard sell signal right here at this top. We get the hard sell signal right here at this top. We get the hard sell signal right here at this top. But we miss out on like this capitulation move right here. We miss out on like this little scalp double top right here. So we want to basically alter it based on the previous history so that, we can get a little more signal action going on here. So maybe we want to move it to like 75 or somewhere around there. Maybe we want to move it slightly lower. Again, it's just about how often you want to get these signals. The more you open up the criteria, the less accurate they will be. So assuming we moved it to like say 75, which is 5-point difference like we did with the bullish control zone, that would give us the sell signal here. 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 So it's going to nail basically all these peaks. So again, if you're in a bull market, you want to have the criteria slightly different for the bear control zone. If you're in a bear market, you want to have the bull criteria slightly different for that control zone. So that is our strict criteria cross basically. And then let's see how that lines up now with our, any cross or like just the initial one that we looked at. So we'll go all the way back to present. And then again, we'll see here, we have like no crosses on this in the bullish control zone, except for like way back here, like Rona action, which, was at like 9,000. So still did okay on that one, but you got no more signals since then. So let's go over to our settings here. And now again, the strict cross signal, we also have the buy and sell strict signal, which again is the exact same thing. So we can turn off the strict cross. And then if we just zoom in here, we notice that it's the same thing again. It's just putting the hard sell, the little S, right at those crosses, but it's only giving you the S when both the stochastics are inside of the bullish control zone. So again, you use that either instead of or in addition to the actual like highlight area as well. So that is our strict cross. And then if we look at the comparison between the two, let's just kind of zoom out here and we'll see all the different, let's look at an area where we have bull and bear ones. So we see we have obviously a bunch of areas where we have the green and the red here. So we now can look at this and we can turn on the any cross signal and see how they correspond. So again, we're going to still have all the same cross signals initially, but now when the two colors interact together, we see here, here's a specific example. This is a bull cross signal, and because it has both the strict criteria, because it's in the bearish control zone, and strict criteria because it's in the bearish control zone, we see it's lit up in that like slightly brighter color. And the same thing with this cell right here and this cell right here. Because it's the strict cross and it's also the any cross at the same time, it's going to turn it a slightly brighter pink color. And you could alter these colors to make it turn like white or, whatever color you want to do. You can switch it up however you want. It's just how I have it set to. But essentially, that way you can identify with both the any cross and the strict cross criteria on. You can scroll through and see, okay, that's a any cross and a strict cross right there. That's an any cross and a strict cross. That's an any cross and a strict cross, etc. So but having the ability to basically fine tune this indicator at will. And then obviously when we pair it all together and we just have, again, I don't have the knife on right now, but we see we have the bearish control zone lit up, and then we get the hard buy signal, bearish control zone, hard buy signal, bullish control zone, hard sell signal, strict cross right here. We can see how they pair up. We can alter these numbers, we can alter these levels, and make it more or less reliable, getting more or less signals accordingly. And then finally, if we just put our last piece of the puzzle back on here, that is our knife. And then we have the entire indicator in all its greatness. So we see obviously the knife can get above our 100 level or below our 0 level, but it's designed not to go too crazy above or below those levels. But we know that when we do see it stabbing out above or below those levels, that it's worth paying attention to. And then just to, what I will do, I will do a quick little dive into the knife for anyone that is not familiar with it. You know what? I'm going to turn off the stochastics as well. So we'll just turn off the alpha and the beta. So here is just the knife on its own. So the idea of the knife is basically, it's essentially for like scalping or picking like tops or bottoms. So again, it's not 100% just because you see a big aggressive knife that has to be the top on the macro. But it's, basically warning you that this is either the top or the next drive we see, look for divergence. So here we see a little top right there and then another push up, and that is our divergence signal telling us we have at least short-term top. And then same thing as well, we have a macro top right here, and then we can compare it to the lower high top right here. And then again, that's telling us there's a divergence between those two peaks, and then we sell off. And then again, we have, a peak to the downside here. We have another peak to the downside here. This time it nails it perfectly. Obviously you're looking to buy, areas where it's down red or sell areas where it's green. But again, you want to trade with the trend. So here again, we see a peak where it's green right here. And then we actually see some continuation. We see a peak right here, and that's the absolute top. We see a peak right here, and that was like an initial bounce, but then continue to the downside. We see a peak right here, and that is like the absolute bottom. Peak right here, and that's the absolute top. So again, it's not 100% accurate. The key thing we're paying attention to is when it's above the 80 level, it's reliable, or below the 20 level, it's more reliable. When we see it above the 100 level or below the 0 level, it's even more reliable, telling us there was a very, very violent move that just took place. And the likelihood is that whatever move took place is not sustainable in the long term. Does not tell us that is going to be the absolute top or absolute bottom, but it gives us a good indication as to whether we're going to see continuation and whether we can look for bullish or bearish divergence. So, and that is the knife. And that is the whole entire indicator in all of its glory. And even if you don't have the stochastics on, you can still use all those different criteria at will. So you can still have it light up the bullish and bearish control zone without even having the stochastic on here. So you can use just the knife with the bullish and bearish control zone with the buy signals if you want. You can use it all together. You can do whatever the hell you want. Unfortunately, this one is only going to be available to group members. But now, as where previously you only got, or not you only, you could only get access to the TJD Master through the group, or obviously showing the support. Now you get a double trouble bonus. You get the TJD BNE, or whatever I rename it, and the TJD Master as well. So obviously phenomenal. Anyone that has been using the Jewel Thief for any amount of time knows that it works phenomenally well. And then obviously put it on display here also tonight. So that is the TJD BNE, or whatever I change it to. You'll know in the title of the snippet for this video. And this is the basically TJD indicator series on how to use said indicator. And if you haven't checked out the other videos on how to use all the other indicators, I highly recommend you take a look at those as well, as there are many valuable and useful indicators available for free, as well as the ones that are exclusive to the group members. So remember also, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Okay, great. So I'm going to snippet that out later, and that will be a little tutorial for that as well. Let's see how my bots are doing. What's up, bots? Good to see you guys. I see you're in here in mass, straight up swarming. It's amazing. It's so crazy that YouTube can't figure out how to block these bots. It's nuts. Or maybe they're my bots. You don't know. Maybe I want you to click on vor.ong. Who knows? Who knows what it leads you to? I don't know because I don't click on it, but God, YouTube is such an awesome platform that I love. Wink, wink. They can't stop scammer streams with thousands of fake people watching them. They tell you if you send them your crypto, they'll send you back twice as much crypto, hosted by Michael Saylor and Vitalik Buterin and Charles Hoskinson. They can't figure out how to block those. They can't figure out that they're scammers and fake streamers with thousands of people watching them. They can't figure out how to block bots that are constantly spamming, scam links. Really, YouTube? You can't figure that out, or you just don't give a shit? I wonder. All right. So, yeah, we nailed the indicator. So what's going on in the chat? How's everybody doing? What do you guys think of the new indicator? 13 people watching. Good to see everybody. Make sure you smash up that like and subscribe button. Appreciate each and every one of you. Obviously, we have been nailing these moves, and we are very much confirming, at least the beginning or potential of a bear market or a market shift. So while we were extremely bullish the entire way up when we are above the 200 exponential and simple and they have a positive slope, and extremely bearish throughout the entire bear market and we have a negative slope on them, right here at these decision points is where we really got to pay attention. So we were able to use triple bearish divergence here to call the absolute top and then sell into this lower high as well. So we took some profits at the top, we took some profits on the lower high, and then we were able to use triple bullish divergence to buy the absolute bottom right here. And we had not confirmed a bear market here, with the exception of like this little guy right here. But we were able to basically scalp some very nice trades on the way back up here. But once again, we were able to nail the top right here based on bearish divergence. Once again, a high, a lower high, a high, a lower high, a high, a higher high. So, and then again on the weekly, when we switch to it, we can see once again, very clear bearish divergence taking place once again. We have a high, we have a lower high, we have a high, we have a lower high, we have a high, we have a higher high, bearish divergence on the daily, bearish divergence on the weekly. And once again, we're able to nail the absolute top. And then we're able to use the 8 and 21 to basically scalp these trades to the downside. And now we are potentially confirming a bear market on the macro, on the daily for long time frames. And we know that based on history, based on facts, not made up things like lengthening cycles and theories and whatever we want to tell ourselves to make us feel good because we didn't make enough money yet this cycle. We know for a fact, an actual fact, we know 100% that every other time in Bitcoin's entire life, the only factual data points we have are a bear market entered in December of 2013 and the bottom of the bear market or beginning of, potentially the uptrend was January of 2015. We know the next bear market started exactly 4 years later in December of 2017, and the bull market or bottom of that cycle was in January of 2019. And now we know that this is signaling that this is the absolute top and bear market in our next 4-year cycle in December of 2021. And then that would potentially give us, this is time cycle analysis. I didn't just draw lines where I want them to be. This literally, when I place this line here and I place this line here, it projects the next line into the future, which is exactly 4 years later. When I place this line here and I place this line here at the two bottoms, it projects this line into the future for me in the exact same time period. So this tells us that this is our top based on that 4-year cycle, which is written into Bitcoin's code, not some fantasy thing that some YouTube person made up called lengthening cycles. Then here we have the bottom, which again, 4-year cycle would tell us that that is roughly going to be in January of 2023. So if this is correct, which it has been every other time, it's telling us that we're getting ready to go into from our top to our bottom of that cycle. It tells us be prepared for a 396-day bear market. So a year and a month bear market roughly, and be prepared for an 89% move to the downside. Does it have to be 89%? No, it could be 82%. It could be 75%. It could be even less than that. It could be even more than that. But we know the previous all-time high to the previous low was 88% in 2013. We know the previous high in 2017 to the previous low was 85%. And we know that the projection based on Fibonacci targets, time cycle analysis, and literally actual facts tells us that the likelihood is we're about to go into a 1 year and 1 month bear market, and we're about to lose roughly 80% of our value of Bitcoin. But that's impossible. Bitcoin will never go to $6,662. You just hate Bitcoin and you're mean. Okay, sure. You're probably right. I'm just a mean guy. And I just hate Bitcoin. And that's why I made a channel called Crypto Trend Trader. And I've been doing this for years. And I've been right regularly. Because I hate crypto. Sure. Okay. Lots of people spend thousands of hours designing indicators, trading, and profiting heavily, making content for free on the internet, spending all their time and resources to educate the community because they hate something. Sure. I'm like the Peter Schiff of crypto. But somehow I make tons of money off of it and call the moves out perfectly and change my narrative when the narrative changes. But I'm mean because I don't like XRP. So what we're paying attention to is, and if you didn't watch the Bitcoin deep dive video, I highly recommend you take a look at that one because I literally go through the entire 12-year cycle, talk about these exact targets, these fib levels, and explain what this clusterfuck of a chart is in extreme detail. And it's probably the deepest dive and the best Bitcoin technical analysis you will ever see. But that leaves our top right here from November and our target to the downside initially of 32,700, which is our initial push down to the 236, and then a bounce roughly back up to 52,339, which would be our lower high and the beginning of our downtrend into the bear market. And then that gives us, we have our A, our B, and then our C, which is our expanded flat Elliott wave correction pattern of the 5-wave cycle, which has been going on for the last 12 years. That gives us our 2 top at 50, roughly 1 or so thousand, and then our 3 down here to the 382, which is roughly 20,900 or 21,000, and then that would give us a bounce back to the upside roughly. Again, we're projecting these out into the future based on previous moves, Fibonacci extension, Elliott wave targets. They are not going to be 100%. They're based on previous price action, resistance and support. But that would give us a bounce from that 21,000 level to retest the macro 236 or the previous support right here, which would be again a push back up to 33,000, at which point in time we would have a high, a low, a lower high, a lower low, a lower high once again, and then we would expect the 5th wave of our correction pattern to play out and take us down. Roughly, it could be anywhere as low or high, depending on how you want to look at it, as the macro 0.5, which would take us to 14,100. That would be a perfectly acceptable low and would completely scare the shit out of anyone that has ever watched Bitcoin, as we have never taken out a previous cycle high before with a cycle low. And then next would be the potential target of the macro 618 at $9,654, which again would scare the shit out of everyone. But in all reality, we would be looking at a target of $6,748, which again, it's like, no, that's not possible. It's impossible. Well, if you use the 5-wave Elliott wave structure, you know that in the 1, the 2 is the retracement of the 1, the 3, we have the 4 as a retracement of the 3, and then we have the 5, and then the initial retracement is just of the 5, but the macro retracement is from all the way at the beginning of the 5-wave structure to the top of the 5, and then we retrace the entire 5-wave structure, which is the blue Fibonacci level here, which the minimum retracement of that would be the 236 at 67.89. The maximum bullish retracement of that would be a retrace to $1,484. So sure, it's impossible. Bitcoin will never go to $1,484. I don't think it's likely, but it is definitely possible. And I could show you 1,000 other charts that have literally done the exact same thing. But right now, you hate me because I'm mean to your Bitcoin. But the truth is, after we complete that 5th wave, that is the end of our 2. And then we go into the macro, which again, we put in a 1, a 2, a 3, a 4, a 5. And then the top of our next 5-wave structure, which is the 3, lined up with our time cycle analysis, would give us a top of our next 12-year and the third wave, which would be December of 2033, and that gives us a $432,000 Bitcoin. So you're like, no, it'll never take that long. It'll never go that low. It's going to 100,000. It's going to 1 billion. I mean, we're projecting way out into the future. So this is the most accurate projection that you can reasonably make. And then we would expect a 4 retracement to the back to the top of the 1 for a maximum low off of that, basically $500,000 high back to roughly, $60,000, $65,000, $70,000. And then finally, we would put in our 5 based on the Fibonacci extension targets, based on our extrapolation into the future, somewhere around January of 2042, which would be a $2,484,000 Bitcoin. So, yep, I hate Bitcoin because I said it might go to $6,000, or I love Bitcoin because I said that it could go to $2,500,000. But it doesn't matter because I'm not biased. I'm going to make money no matter what it does. If it goes to $1,000, I will make money. If it goes to $2.5 million, I will make money. And I will continue to use actual facts, math, and technical analysis. I will not get my emotions in the way. And I will continue to provide useful content to the community for stocks, cryptos, commodities, bunches and bunches of free technical analysis, fundamental analysis. I'll even talk a little bit of politics. I might just go on a little rant here and there. I'm going to use funny voices, and I'm going to do the majority of that for free. But every once in a while, I might ask for a little bit of, contribution to help fund my work and the amount of time that I dedicate to this channel. And for that one-time contribution, you know what I offer you? 2 awesome fucking indicators. The TJD Master and also we'll call it just the TJD BNE for now. But those are available strictly to group members. So for anyone that does decide that they want to support the channel or they enjoy the content that I put out, you do get exclusive access to the group and permanent access to those indicators as well. But that's enough shilling, and that is enough technical analysis. Should we look at the tech sector? We really don't even need to look at anything from here on out, to tell you the truth, because the truth is, as long as we are seeing the yields threatening the macro high on the 10-year, as long as we're seeing yield curve inversion on the longer time frames, I really have no interest in tech right now. I have no interest in companies that are not profitable. So we already looked at the dollar. We can rip through here real quick. This looks very toppy on Tesla's part. Got to be real careful. And then Elon Musk is selling billions of dollars worth of this asset that he owns. And then on top of that, he's calling for a bear market this year. That's weird. Lyft, bear market already. Uber, bear market already. And the top of our descending channel as well. Discovery almost hit our target. Very much in a bear market. Viacom, very clearly in a bear market, halfway to the target. I am fully prepared. Anything that has not gotten stopped out right now, I'm fully prepared to either exit willingly or get stopped out on, as I do not expect these tech stocks to recover. Pinterest, bear market. Snapchat, bear market. A lot of these are putting in 52-week or cycle lows as well. Peloton, going straight to zero and bear market. Airbnb, bear market. Zillow, bear market. New lows. Wish, bear market, almost at zero. Bumble, bear market, new lows. Alibaba, very much bear market and, pushing down to those new lows. Baidu, bear market, new lows. And this is why this indicator is so good. The TJD Master is amazing because you can literally take 1 second, look at a chart and see, are both these pink and red? Are both these blue and blue? Okay, bull market, bear market. Perfect. So we know, do we want to take longs? Do we want to take shorts? Do we want to buy this? Do we want to sell this? Do we want to skip this? 10-cent music, bear market, new lows. BZ, chopping, doing nothing. Doesn't even have enough time frame for determinant. JD.com, bear market. New lows. Neo, I mean, this thing has literally done. Neo is our bitch. It literally has done exactly what I said. So I honestly would not be surprised to see this bounce back up here and retest $35 before it goes and puts in a new low, because it has been trading so technically. But again, bear market, new lows. Nvidia, still in a bull market. Definitely one of the few things holding up this entire market. But we have basically retested that potential neckline. And this is exactly what we talked about this top. So we have a high, we have a neckline, clear support, we have a lower high. If we break down from this right here, we're going to retest the 200 exponential and simple. And remember what I said, there are 4 key components to the stock market or these assets, and the potential of a recession or a top or a slowing economy or a depression or whatever you want to call it. I literally called out exactly the top in Bitcoin 2017, the top in the stock market, and Bitcoin right before the CVD dump, called out the exact top in Bitcoin both times, this time as well. So it's probably worth paying attention to and at least listening a little bit, even though this is not financial advice. But how did I call the bear market and the CVD dump before it happened? How did I do it? Using 4 things: transportation sector, semiconductors, the spike price in energy. Very important that we pay attention to these things. And then obviously the flattening of the yield curve or yield curve inversion. Using those 4 factors, and especially if 1 or 2 or 3 or if all 4 give us our signal, the likelihood of a bear market, or not even a bear market, a recession, or potentially of a depression, literally goes from very low to basically 100. Because every single time we have seen, you know what, and that's what we could spend the rest of the stream doing today. We could take a quick glance back at those. But the last few times when we have seen the 2000 top, the 2008 top, and the COVID top, every single time we saw all 4 of those things trigger. We saw semiconductors top out. We saw oil or energy go parabolic and top out. We saw the yield curve invert. And then finally we saw, which one did I miss? I said what? I can't remember which one I didn't say right there. Yield curve invert. So, transportation and transportation sector top out. So again, we're literally seeing the potential of all 4 of those things happening again. And we're at a pivot point on crypto for a potential bear market. We're seeing bearish divergence on crypto on the weekly, on the stock market on the weekly. We're seeing potential top out in the strongest sectors in the economy. We're seeing energy spikes that we have not seen and levels that we have not seen, since 2014. We're seeing yield curve has already inverted on longer time frames in the United States on treasury bonds and flattening on shorter time frames. And now we're talking about 3 potential rate hikes this year, and spike highs on the 10-year treasury yield. We've already seen yield curve inversion in other countries. I mean, if there was ever a signal that we are potentially going into another recession or potential depression, and that there's going to be some serious opportunity and market crashes in the near future, if ever there was a signal, just like there was before the CVD dump, it's happening all over again. And all these things are happening at the same time. So it's for sure worth looking at. But if Nvidia breaks down right here, I expect it to come back down and retest the 200 exponential and simple. This has been one of the strongest and the market leaders and propping up the entire stock market the whole time, and I've been screaming at the top of my lungs, Nvidia is the best. You're the best, Nvidia. AMD, same thing. Looking like it's about to top out, getting ready to come back down and retest our yellow support, or blue 200 exponential or simple. Intel, the trashiest, worst, most horrendous semiconductor company in all the world, still has not put in a new all-time high since 2000. And now all of a sudden, We have triple bearish divergence on the monthly, and we have broke down below the 8 and 21, and this thing is getting ready to absolutely capitulate to the bottom with triple bearish divergence on both indicator oscillators on the monthly. And now all of a sudden, it wants to try to grow a set and break out to the upside. And what happens? It enters into a bearish, a bear market, and then gets a massive spike high rejection shooting star candle. This thing is about to get wrecked. That was the short squeeze before wreck city in this bitch. We were just in the most bullish market ever in stocks and semiconductors and cryptos, and this thing did nothing. Didn't even put in an all-time high from 20 something years ago. Taiwan Semi traded sideways inside this range literally since, with the exception of this little spike high right here, we literally traded inside of this range since March of 2021. And all of a sudden, Taiwan Semi bursts to the upside and then sells back off. So what's going to happen right here? Well, if this doesn't hold right here after it did nothing while every other decent like Micron, Nvidia, AMD, they all went absolutely parabolic and crushed it. Even the semiconductor ETF went parabolic and crushed it, and this did nothing. And now all of a sudden it's going to spike up right here. I mean, is that a failed breakout? Is that a throw over? I mean, it sure looks like it to me. Let's look at the knife. Is the knife sticking up here to like over the 100 level, and we break through clear resistance that we've been respecting this whole time? I mean, if ever there was signals showing up in these markets that shit's about to hit the fan, it's now. SMH, VanEck Semiconductor ETF, again, looks very, very toppy at these levels. Very clearly bearish divergence playing out as we speak. Not as clear of a lower support zone, but if we start to break down from like 295, it's going to look super sketch, and I expect it at 268. Semiconductors looking toppy for the first time this entire cycle. ARKK, new low. I mean, is this thing going straight to zero? Is Cathie Wood the dumbest, most idiotic, worst investor ever? Yes. No, probably not ever. But this year, for sure. 100%. Who was literally making songs, making fun of Cathie Wood and how bad she sucks and the record outflows and how she was going to underperform the market and how her stocks are trash and she was just going to lose people money? Oh, I was. If you don't believe me, just go to my main channel page and you can hear me sing about how shitty Cathie Wood is. Yeah, looks terrible. Looks absolutely terrible. So anybody that bought into ARKK, the innovation ETF, from September 2020 onward is now negative. They have now lost everything. I mean, she is total trash. 46% down, while the S&P 500 went up 28%. She lost 46%. Great fucking job, Cathie. Great job. Winner. Teladoc. I'm not even looking at the other ARK funds. They're all trash. New low on Teladoc. Looks absolutely horrendous. Absolutely horrendous. Clearly in a bear market. Total trash. Lemonade. I mean, this big red square is anybody that ever bought Lemonade. And then now look, a new low down here. So even the guy who just bought it is underwater. So total trash. Worthless. Palantir. New low. Took out the low right here. No support. There's like 5 days worth of support. So looks like we're about to head down here. We are at the 618. But almost at the measure move. So is Palantir going down to $12.50? Probably. I would expect some kind of support at this level it's at now. But again, total trash, clearly in a bear market. Unity Software is at least maintaining for now. Barely has not flipped over to 200 simple. But even this thing looks ready to go into a bear market. I actually like this company. I'm not going to lie. Corsair, very much in a bear market. And again, I'm not trying to be mean. My computer that you guys are watching literally has Corsair components in it, and I love them and they work great. But there's a big difference between a good stock and a good company. This is a great company. This is a shitty chart and a shitty stock. It is in a bear market. It sucks. PayPal, bear market. Looks absolutely horrendous. Horrible, horrible PayPal. Terrible. It is down from the all-time highs. PayPal is down right now 40%. 40%. Square, even worse. The worst and the trashiest. Down 50% from the all-time high. Total garbage. Bear market, obviously. Twitter, you guessed it. Bear market, total trash. No one has ever made any money in Twitter, ever. If we zoom way back here, we can see that the IPO price on Twitter from 2013 is right where we're at now. So literally, if you bought it right in the beginning and you're still holding it now, you just went sideways for the last 8 years. So you spent 8 years in Twitter, and it grew massively as a company and is gigantic now, and it's the biggest platform and the loudest megaphone, and it's worth no more to you as a shareholder. Trash. eBay, damn near confirming a bear market, getting rejected here. It's so close to a bear market right here. And again, you guys know I like eBay, but let's speak the truth here. Amazon doing exactly what I said, losing the 200 exponential, barely still has the slope on the 200 simple, but we're headed down here to the heart line once again at 31.78. And if that fails, we'll confirm a bear market, and then we'll come all the way back down to the bottom of the channel, and that is where my buying opportunity is. I will be looking to purchase Amazon, potentially, depending what's going on with the world and the markets. I will be looking to at least scalp, if not invest further in Amazon at $2,860. That is my target for Amazon, and it looks very, very likely right now, as we are potentially confirming a bear market on one of the few stocks that was actually strong. Well, Amazon wasn't really that strong. Apple looks okay, looks kind of toppy right here. Definitely putting in bearish divergence. What did I say about Apple? It's going to push up to $3 trillion market cap and maybe even $200, but more importantly, $3 trillion market cap. And then we're going to see some serious pressure. And a lot of big hedge fund and smart people are treating Apple like cash because they have to be invested in these markets. And I'm going to tell you, if these markets turn, you're not going to be worried about a little 6%, inflation eating away at your cash. You're going to be worried about the massive downtrend on Apple, because just a reversion to the mean from the high right here to 200 exponential and simple is 20%. So do you want to lose 6% in cash to inflation over a year, or do you want to lose 19%, in a couple days if Apple pulls back? That's not cash. These are not cash. They're cash-like substitutes? Sure. Not for normal people. Don't listen to what these big dogs are doing and think that that's how you're going to manage stuff. They're not allowed to sit in cash. There's literally rules for their funds, depending on, what it is, if it's an ETF or hedge fund or family office. There's strict criteria and rules that a lot of them have where they can't just keep a large position in cash. A smart person, an investor, someone looking for opportunity will easily pay the 6% inflation or whatever it is for the option to buy whatever they want when it's time. And that's what I'm doing right now. And this is not financial advice. I'm not telling you what to do, but there's a reason I'm doing it. Facebook looks like total trash. Breaking down here, looks like it's about to lose the 200 exponential and simple. Already flipped the 200 exponential bearish. So not quite in a bear market, but very close. Google looks absolutely terrible. Broke down from the descending, channel right here. Lost one key level of support. I would expect it to try to hang on here, but we're very close to coming down to our target, the 200 exponential and simple, and our green support here at 2,665. Again, I'll potentially be looking at this as a buying opportunity, but the speed at which it's coming down here tells me this might not hold. This may just turn into a head and shoulders pattern. This may break down from here. I don't want to see this happen. Remember, we have not seen Google touch the 200 exponential and simple at moving average since September of 2020. So it has not even come close to it, and now all of a sudden it's threatening it. So that's either the best buying opportunity ever or a potential transition into a bear market. And we know that the 200 simple has crossed above the 200 exponential, so we have lost momentum and we're getting giant red candles. So is literally the entire stock market threatening bear market territory right now? Sure looks like it to me. Microsoft, one of the strongest by far. Again, Apple, Microsoft, arguably Nvidia, AMD, Google, Tesla, like a couple of these key stocks have been propping up this entire market right now. And we're even seeing them look nasty. So, Microsoft looks like it wants to come back down to like 305, potentially touch the 200 exponential and simple for the first time since March of 2020. So, again, every other time it's gotten front run. So maybe we don't get there. But I'm looking at this level down here. Again, this is I'm not looking at this as time, guys. Remember, when I put these boxes in place, I'm looking at it as levels, not for when it's going to go into that box. But here with the 200 exponential and simple creeping up, I would look at this as probably a buying opportunity myself. But we'll see. I mean, we're almost there awfully quick. So, and last but not least, DocuSign, bear market, total trash, rolling over, going straight to zero, no value. There's no value in this. It does literally nothing that nothing else can't do. It's absolute trash. I mean, doctors are still drawing on paper charts. They, like, this is just all of a sudden, I mean, there's a million other ways that you can sign documents. If you're a company or, whatever you're going to use DocuSign for, there's a million other ways to do it. Matter of fact, if you give me the opportunity to buy either DocuSign or use the blockchain, to basically trustlessly sign documents, I'm going to go with the blockchain. Okay. So let's take a blockchain version of DocuSign over this trash bag useless company that does not, I mean, it's not like all of a sudden realtors and, mortgage underwriters are going to start using like DocuSign exclusively, and it's going to like take over and capture 95% of the market share. These are all just bullshit pipe dreams of companies that have no proprietary value. So absolutely terrible. I mean, the narratives are starting to really shift on this stuff, and hopefully people are going to wake up before it's too late. Gold and silver barely hanging on right here. Silver's already in a bear market, barely hanging on to support. Gold is barely hanging on to 200 exponential and simple. What are the two main things gold has to worry about? Rising rates and strength in the dollar. And what are we seeing right now? Well, neutral to strength in the dollar and quickly rising rates. So looks very likely that gold is going to break down into a bear market, and it's going to repeat 2011 all over again. What are we at? 2 hours and 41 minutes? Yeah, I'm not going to rip into, we could do our commodities really quick. Gold silver ratio. Again, gold looks better than silver. It's reclaiming the 200 exponential and simple, potentially strengthening to the upside. Platinum looks very weak, clearly in a bear market. Copper rallying up, still inside the zone here. So we're looking at the resistance up here in green. We're looking at the support down here in red. And then here's like basically like our key levels are like the orange support. So we're basically in the middle of the zone right now. Lithium, basically coming down here to retest 200 exponential and simple, almost to our target area, at which point in time I would expect a bounce, reevaluate for at least a scalp trade. Hydrogen, new lows, looks absolutely terrible. Absolutely terrible. We had talked about this trade setup right here. Man, I think I was actually planning on taking this, and I just never did. But yeah, new lows, looks absolutely terrible. Oh, it was because of the end of the year, and I told you I wasn't going to open any new positions. That's why. Lumber, absolutely crushing. I mean, this thing's going parabolic. This is pure speculation on the futures market. This has nothing to do with technicals or fundamentals. USAS, this thing's going to get absolutely wrecked if gold and silver get wrecked. Pot stocks putting in new lows still look absolutely terrible, but I'm not going to lie. I'm starting to dip my toes and accumulate in these. I talked about Hexo. Matter of fact, Hexo was one of the few positions I have actually opened up, and I do expect further downside on these pot stocks. CGC, terrible new lows. URA, spiked back up here and got a pretty harsh rejection. I do still love uranium, but could go either way at this point in time. I really do want to see this just chop sideways, but it could easily have another push up here, or it could easily go down. But on the longer time frames, I'm really just looking for uranium to go sideways for a couple months. UEC, these all look the same. URNM, Cameco, or CCJ, all just like spike tops here. They basically just look like shooting star rejections. So I do expect further downside on them. Caterpillar, aggressive move to the upside. We saw this in the industrial sector here. Caterpillar, we saw Deere, we saw quite a few actually of these things spike up here. I really think a lot of these are short squeezes. So we have reclaimed the 200 exponential and simple. I don't want to get overly bearish right now, but I don't trust this move right now. Deere, same thing, a spike rejection. We spiked out of the resistance and we got a hard rejection right here. That looks to me like it's probably going to at least come back down and retest. This was very close to confirming a bear market, and this looks like an option short squeeze to me. Intero midstream, again, reclaim the 200 exponential and simple, potential like spike top or rejection or shooting star, whatever you want to call it. Cemex, same exact thing, underperforming, not even getting back up to the 200 simple. Not interested in like anything right now. Ford, beautiful move back to the upside right here. This thing is absolutely just dominating. So, arguably I took profits too soon, but you know what? I'm pretty responsible about my rebalancing. So, Ford position was just getting out of control. And if it keeps just going up by 20%, it's going to keep just getting fucking out of control. So, but it is what it is. I mean, it's very, very strong. GM, not quite as strong, but it did put in a new all-time high right here. Pretty aggressive selling coming in too. Hasbro did finally get above that 100 level, but getting rejected at that previous high right there. Man, I keep saying that I'll get bullish on this if something happens, and then it keeps failing. So we'll see. I just, it's hard for me to try to put in this money to work right now. Works came down here to our potential entry level. This could still be a nice scalp. It's at the potential entry price right here. But again, I'm just not trying to rush back into these things. It's a decent trade setup, 44%, 8% stop loss, almost 6-to-1 risk reward ratio. But I'm just not looking to jump right into it right now. Same thing with any. We finally got down here on Sphere to our target. Been basically, we crushed it on the way up here. Been calling out this area for our potential target for the scalp to the upside. I don't know why I have this trade set up right here. You guys know, obviously, my target is this blue box and the bottom of the potential right shoulder here. So we're basically at that level. So I may take a small position, a small entry on this level for what could amount to a massive inverted head and shoulders, buying basically the bottom of this channel. But if I do, it's going to be a small position, like not even like, depending how you do risk reward or position sizing, if we talk about our trading account being in like 10 units or something like that, I'm talking about like a fifth or a tenth of a unit, like not even close to a single unit, not even half of a unit. It would literally just be a highly speculative small position, with, exponential risk reward, obviously. But okay, so I'm gonna jump over in the comments here, chat with you guys for a second, and then we're gonna go ahead and call it here. Got about 15 minutes, so if anybody has any questions, comments, or anything like that, I'd be glad to chat it up a little. So I appreciate everybody that has watched today. I appreciate each and every one of the group members. Looking forward to debuting the new indicator. Hopefully you guys are getting freaking excited about it after the little demo here. We'll be probably publishing it. I'm probably not going to do it tonight. I'll probably do it tomorrow or whatever. And then I will share the link in the Discord for you guys. Let's see. Honkiness, what's up, brother? Could you talk about liquidating or not liquidating investments at this time? Man, that's a broad topic that is very specific to each and every one of us. For me, inside of trading accounts, I have little to no interest in positions right now. But as far as, other than like quick little scalp trades, but as far as like actual investments, depending on what your time horizon is or like what mine is, and it's a tough call. If you're looking at like a retirement account or whatever, like I'm hesitant to tell people like, that I would just start like dumping my assets or anything like that. Because I don't. I usually just rebalance and then, basically add over time. Whatever, whether it's 401k or an IRA or whatever. I'm in the camp that if you have a long time horizon, that essentially you should just be a net buyer, or that I'm a net buyer over time. And I can't speak to your specific situation, nor would I give you specific financial advice. But I think I would base it probably on what kind of cash position I have and, how safe my portfolio looked or felt, coupled with my time horizon. So, if you're 40 years old and you plan on retiring at 65, you have 25 years to buy if there's a massive, downturn in the markets. So if we see a recession or depression or something like that that lasts for 1 year or 3 years or 5 years or 10 years, you have ample opportunity to continue just buying at phenomenal prices. So I would be much less concerned with like liquidating things as long as I can continue to deploy capital, at ideal prices. But if I was, 60, looking to retire in a couple of years, or 50, and all of a sudden getting stuck in a sideways market for a decade, or a capitulation move over the next like 5 years, time or price capitulation was going to threaten my way of life for retirement or whatever, it would put me in a different situation. And I would already be out of a lot of risky assets, but definitely be looking to de-risk. And then the opposite, obviously, if I was, 20 years old or 25 years old or something like that, I would literally just be making regular purchases, the lower assets get, but I wouldn't be buying crazy speculative trash bag tech stocks, or cryptos on the way down. I would be buying actual companies with good valuations, low, ratios of, not sales, like profits, like PE ratios, long histories of dividends, strong fundamental and technical charts, and when I'm talking about things like, I like Ford and Caterpillar and Deere, and, we've talked about like some of the oil companies, Exxon and Marathon, and, some of these like long-term, core blue chip companies or indexes, you know what I mean? S&P or Dow, but I would not be looking for emerging markets. I would not be looking to just like liquidate my entire portfolio and just sit in cash either. But again, if I was 60 or 65 or older, I might be singing a different tune right now. I think that, time is a huge factor. And also, I think that's the main point I want to make is that depending on where you are in your life and how close or far from retirement you are, if you have a nice sized portfolio, but you have 40 more years to add to that portfolio, the best case scenario is that your portfolio goes down by 66%, because that means that the whole time you're buying things at pennies on the dollar. So if you're buying good companies and good stocks, by the time your portfolio recovers, it will be worth 20 times as much as you ever lost. And if you're not selling, you're not technically losing, you're just sweating. So that's how I look at it. But, on a 20-year time horizon, still the same goes. 10-year time horizon, a little less aggressive. 5-year time horizon, I would be putting my money in store of value things like gold and silver, honestly, because I wouldn't be chasing yield. I would be looking at, dividend stocks that are very little volatility and solid. But again, it's tough for me to, one, I don't want to give anybody financial advice, nor would I. But two, it's different for everybody. It's depending what your portfolio looks like right now, depending on how much it's up or down, depending on what your time horizon is, depending on how risk adverse you are. Like if you could just stomach a 66% drop in your entire portfolio, but you have 40 years till you retire, I wouldn't even sweat it. I would pray for a 66% drop. I would pray for a 90% drop, because I would just be buying up good companies the whole way down, laughing my ass all the way to the bank, knowing that you're going to be a 100 millionaire or a billionaire by the fucking time the markets recover. And praying that you get 10 years to buy something at 90% discount, if it's a good company, not just some trash bag, like Rivian or something. No offense to Rivian specifically, but again, obviously not financial advice. Did you dump investments with C crash? Oh yeah, I sold a lot of stuff before the COVID dump, man. Yeah, I did. And arguably that was a risky move. But leading up to that, I did not have a large cash position. So essentially when I exited, I had a decent amount of cash position in, what I would trade or invest in crypto. But I had taken profits on Bitcoin at close to like $14,000 and then scalped a couple times along the way, but I was out for the dump. And then I was basically buying like 4 and 5,000 and on the way back up. But I had positions in Bitcoin from 4,000 initially up to 14,000 that I never closed. I had positions in Ethereum from, $85, but most of those were more like quote unquote long-term investments. But I had plenty of capital to like deploy. As far as like stocks, though, it was not the case. I don't just keep a ton of cash on the sidelines until I started seeing like those warning signs. Again, like the yield curve inversion, the semiconductor space, obviously the transportation and energy sector. So that's and that's basically when I made the channel, was essentially like, I don't want to say like warning people or predicting the crash, but I think I made the channel in like August and the crash was in March. So it wasn't that far ahead. It's not like I was predicting it for 10 years sitting on the sidelines. I was expecting it like around August. I was expecting it to happen. And then I was with my family in January that year, like right after Christmas, with some family members discussing it or whatever. And that was around the time that I was basically like de-risking or, exiting my stock positions, like with end of the year selling and then obviously beginning of the year selling too. And in my opinion, the best two times to buy and sell are the end of the year and the beginning of the year. Because you can obviously do like taking profits, tax loss harvesting, or if you take profits in January on like a nice position, you have all year before you have to pay taxes on it. So it's nice, you can deploy that capital and do whatever with it. So, but again, it's to each his own, but it all depends on the size of your cash position as well. So bots going strong. Gotta love these bots, man. Man, they're just great. There's just a never-ending supply of them too. It's amazing. But somehow YouTube just can't figure it out. So, but yeah, I think that's gonna call it for today, guys. Hopefully everybody enjoyed the screen. Hopefully you guys smashed up the like button. Enjoyed the stream today. Looking forward to the indicator for anybody in the group. If you're not in the group and you are interested in the TJD Master or the TJD BNE as it's named for now at least, let me know. You can obviously get my email from down in the description of the video. If you're not interested in supporting me or the channel, but you would like to use the free assets available, you can always access my chart and all the other free published indicators and the countless amounts of videos, technical analysis, how-tos, and all that stuff available as well. So I appreciate each and every one of you. Make sure you take care of yourself, protect yourself. We've been talking about this move for quite some time, and we are literally at the turning point for the potential beginning of a bear market in cryptos. We're seeing massive amounts of bearish divergence on weekly and monthly timeframes throughout these markets. We're seeing a massive move in the 10-year Treasury and strength in the dollar, telling us basically that things could potentially be shifting. If we take out that macro high, on the Treasury, on the 10-year, that is going to be a big effing deal. Not just because of the level, because it's only 1.7. It's not that high. It's the speed at which we got there, and it's the amount of pressure it's going to put on the valuations, amount of pressure it's going to put on, the stock market, especially tech, the crypto market, anything speculative. And then also, obviously, mortgages, and then obviously the bond market, and the bond market, let's remember, is like exponentially larger than the stock market. So if we see some serious damage happening to the bond market, we're talking about big amounts of money and big swings in value. Not little $1 trillion moves like what we could potentially expect in crypto. We're talking about tens and hundreds of trillions of dollars. I mean, immeasurable amounts of money, unfathomable amounts of money, and value potentially created or destroyed. So what happens now could be a big effing deal. And the fact of the matter is, the people are literally, I don't know what it's like everywhere, but when I see people demanding that governments do something about inflation and, struggling, my heart goes out to those people. And knowing politicians, their first and initial thought is to cater to their donors, cater to, the elites that fund them. But the fact of the matter is, if they can't keep their position of power, if they can't stay in office, they don't give a damn about their donors because they lose their power. So their number one priority is maintaining that power. So if in order to maintain that power, they need to fight inflation and they need to fight it fast, I would not be surprised in the least bit to see people calling for immediate damage control, immediate rate hikes. And we have, the next, don't we have tomorrow, Jerome Powell coming out? What is tomorrow? I can't even remember. I want to say we have Powell coming out. It might be the 7th? God, I can't remember. I should have looked at the schedule, but we got one coming up here. So, or do we? Damn, I can't even remember. I'll have to look at it. But we're definitely at a inflection point. The beginning of the year, a couple years after the last recession, we're seeing a bunch of warning signs. We're seeing, potential bull markets turning to bear markets. We're seeing trillions of dollars in value, destroyed in days. We're seeing the smartest, arguably, and richest man on earth, Elon Musk, calling for a recession/bear market, selling the absolute top on Tesla, one of the strongest stocks in the market. And, lots of these other billionaires and the smartest, most intelligent market maker, market mover, wealthiest individuals alive with the best track records saying the stock market, the crypto market, the world economy is potentially like rolling over and we could see some serious pain. Seeing all these people saying the same thing, and then we see all the plebs, all the people on YouTube, all the, people that have been in the market for the last 2 years, the crypto cult, the Robinhood and, new investors or speculators or whatever, all saying, this time's different. We're going up. We're going to 1 million. We're going to 1 zillion. I'd be real careful because it sure looks like we sucked in all the dumbass people, all the young people, all the dumb people, all the, whatever you want to call them, new people into the market only to have it run up and basically them to lose everything and make nothing. Think about how many people came into this market in the last year and everything that they invested in is literally sideways or down since then. I mean, when did Bitcoin top? When were all these gains put in? Nothing has happened in the last year. Other than if you were scalping a couple things, there were no gains made in this last year. I mean, with the exception of Apple, Nvidia, AMD, maybe if you scalped a couple moves in crypto, nothing has been going up unless you were in basically the index fund or one of a handful of stocks. You basically made nothing. It just went sideways or down. And then look at how many things are down 50%, 60%, 80%. I think we're going to see a lot of pain here into the future. So everybody be careful. Protect yourself. We're going to wrap it up with that. Appreciate all you guys tuning in today. Remember, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research. Trade responsibly. Number one priority, protect your principal. Protect your capital. You cannot protect if you lose it. And you cannot grow it if you lose it. So, number one, don't lose. Number two, make gains. That's how I look at it anyway. So, risk reward, position sizing, technical analysis, intelligent investing based on, fundamentals and value of stocks for long-term stuff. But get away from the speculative stuff. Be careful, with the quote unquote store of value argument in cryptocurrencies, because they're not going to look like a store of value if they go down 80%. And, it's happened every other time in the past. So, and same thing with the dot-com bubble burst. Same thing with the global financial crisis. Everybody said these things will never go down. Amazon went down 90-something%. so many things. Housing market crash for years. Got to be real careful here, guys. We're at an inflection point, and we're seeing way too many warning signs. So if you are interested in joining the group, shoot me a message. Obviously, we'll have access to the 2 indicators, including the brand new one as well. But that's going to wrap it up for today. Make sure you check us out on our Wednesday stream, which will be at 8 p.m. Eastern Standard Time every Wednesday, and Sunday stream rather, every Wednesday and Sunday from 8 p.m. till roughly 11 p.m. Eastern Standard Time. Today is January 5th, 2022. I am Crypto Trend Trader, and I'm out of here. Oh, and goodbye to the bots. I'll miss you guys. See you soon.